Yeah. Yeah. Nope. Oh, mine's on.
All right. So, Global Independence Conference topics are digital money, centralized finance, and the proposal of crypto. All of our conferences, when Jill runs them, start on top. So what we're going to do here is Jill's going to give you a brief history, 2.5 minutes, of how we got here, Global Independence Center. And then I'm going to kind of do the rules of the road for the day. And then we're going to start. Jill, you're up.
Breakout stand-up routine. All right. Good morning.
Good morning.
Good morning. I went to Catholic school, so we have to say it back. Good morning. So my name is 𝗪𝗶𝗀𝗶𝗀𝗲𝗿, and I am the Executive Director of the Global Interdependence Center. And I would really like to thank you all for joining us this morning. I would like to thank Strategas and Sycamore Tree Capital Partners for their support of today's program. And I would like to especially acknowledge 𝗣𝗵𝗁𝗍𝗑, who has championed this program and assembled a dynamic agenda for today. So thank you so much, Steve, for everything that you did. My role this morning is to introduce a 2.5-minute video that encapsulates 50 years of history, which you are all now a part of, and this is for the Global Interdependence Center. So I hope you enjoy the video. I think Rob worked on scrubbing my Philadelphia accent out of the video. But in case you don't hear it, I do feel compelled to say, go birds.
Welcome to the Global Interdependence Center's conference on digital money, decentralized finance, and the puzzle of crypto. I am pleased to introduce the GIC and tell you who we are, how we got here, where we've been, and how your participation today contributes to our vision of striving to be a leader in influencing world policies for the greater good through cooperative international engagement among diverse thought leaders. The Global Interdependence Center, known as GIC, was founded in 1976 in Philadelphia by Frederick Heldring, 𝗪𝗹𝗶𝗏𝗍, and Nobel Prize winner Lawrence Klein. GIC brings together a network of international experts in policymaking, central banking, industry, and academia to explore issues and policies concerning global interdependence that impact world economies and quality of life. We provide a neutral, nonpartisan forum to expand awareness, advance shared interests, and promote social stewardship. Since its inception, GIC has hosted 58 international programs throughout 29 countries, covering a diverse range of topics such as food and water scarcity and its challenges to international stability, central banking, monetary policy, QE, trade, and emerging markets, the economic impact of COVID-19, and the roles of higher education in competitiveness and global productivity. In 2018, the Global Interdependence Center announced its College of Central Bankers. Our College of Central Bankers, now with over 20 fellows, provides a distinguished forum for former leaders of monetary policymaking organizations to share their insights and thought leadership on critical issues facing central banking and global monetary policy. On a final note, GIC is a 501c3 nonprofit organization. Our conferences are funded by voluntary support from our corporate and individual members. We thank our extraordinary speakers who are with us today, who have come at their own or their firm's expense to join you and contribute their time, expertise, and voices to expand and deepen the global dialogue. Thank you and enjoy the conference.
So what I'm going to do for a minute here is go through how we got here. I'm going to explain why I'm standing in front of a podium that says UCSD Rady School. It's not a random event. And then just go through some logistics and protocols. So the most important thing, anybody who parked across the street in the parking lot under the lot, you know where the movie theaters are, you kind of want to take a break and move your car because they've auctioned off the right to that lot to some company someplace. We had somebody here 2 years ago who parked there, and when they got the $125 bill for the day, I said, that's insane, I'll go get it fixed. I couldn't. So if you're parked there, you want to move. So here's the agenda today, and I just want to give you a sense of how we got here. So in 2016, 𝗣𝗵𝗿𝗲𝗏 and I were walking down the street coming from a dinner, and I said to Dave, do you understand this Bitcoin stuff? Dave goes, no, not really, but there's some guys at the Fed that are working on this that are really good. And so one of the guys at the time worked for Governor Waller, who was then research director at the St. Louis Fed, 𝗣𝗵𝗿𝗏𝗏𝗏 and others really spent a lot of time educating us, and we said, well, we should have a conference. And at the same time, there's a parallel group, affectionately known as NBIC, the National Business Economic Issues Council. It meets 4 times a year. Surprisingly, every 2 or 3 years, they want to do the quarterly meeting here in San Diego. And so we just finished our 2 days, and we said, well, we'll combine them. So in 2017, we did a conference like this, and we've done 3 more. And we've partnered up with UCSD and Michael Melvin, who's going to run the panel on investing. And the idea is, and it's kind of the general GIC thing, is there's basic things we're trying to understand, and we try and get people together who understand them and then talk about it. So we will have a lot of dialogue. So I'm going to go through the agenda. We're going to start out with digital assets with Governor Waller. And I've described this as the year of crypto demolition, like kind of for those my age, disco demolition in Chicago. But at the end of the day, there's all this technology that's happened. We have 5 billion people with supercomputers in their hands. You know, all of a sudden you got these new words. I got crypto this, I got cryptocurrency, I got crypto assets. And if you're me, I'm like, I don't understand this. And so part of the spirit of today will be, what is this and how does it work? And then how does it connect everyday real life in the economy? So we're going to start out with Governor Waller on just digital assets. And I think there'll be a couple surprising things, especially for the investors in here. We have the people I work for at the county pension plan, the trustees in the room, as well as our CEO, Tracy Sandoval. We have members from the city system, as well as other investors. And then we're going to talk about decentralized finance and DeFi. And here, literally, here's how this happened. I was at an outing, and one of the big asset management firms, WisdomTree, and was talking to Jeremy, and I go, what are you doing? And he goes, well, we're tokenizing all of our products. And I'm like, tokenize? I look it up. I go, it's not even a word. It sounds like a verb, but it's not a word. He says, yeah, but we're tokenizing them. And I'm like, what do you mean you're tokenizing them? And so I start pressing him. He says, well, as it turns out, there's a guy who really knows this, and you're going to have to talk to him. And so better than that, 𝗵𝗿𝗏 is that guy, and Will is here. And so he's going to talk to us about tokenizing, I'm going to make up a verb, assets. But as it turns out, I did look up token. It goes back to 1890, the word, and it's a record. It's the recording of a fact. So I think the surprise will be in this session, they will demystify some of these words, and it could be pretty broad-based. I got 2 separate data points that said the same thing. So Governor Waller had, working for him in St. Louis, a professor at the University of Basel, Alexander Berenstain, who was going to be here, but he had a family conflict. And he basically, in one sentence, says, the existing financial infrastructure doesn't know what's coming at them because of this change in technology. So I just want to amplify technology because I think one of the things that President Harker will go through is the work they're spearheading, and I'm going to try and ask him about it, to get ahead of this crypto computing competition. And to me, at the end of the day, it's all about record keeping and security and trust in transactions. And then the third session with Michael Melvin's going to run is crypto is an investment. And like I'm over here, like somebody says, well, do you own any crypto assets? I'm like, what are those? What claim do I have on anything? And Michael initially had a similar reaction, but as it turns out, when you really like work at the words, you can do it, and it's not a crazy thing. And Tom Jessup is here from Fidelity Digital Assets. I'm going to go back to Decentralized Finance because that also connects to Jim Bianco. So the next connection to Alexander was Jim Bianco, who's here from Bianco Research. Jim's been bending our ear for 2.5 years about how the existing infrastructure has no clue what's going to happen to them because of, quote, crypto. So the morning's going to be trying to figure this out. But at the end of the day, the purpose of all this is not to do crypto, it's to allow the economy to function and grow. That's the purpose. The Nobel Prize winner, Robert Shiller, had a great sentence that says, oh, this is all fun, but the real purpose is to enable people to do their jobs and the economy to grow. And that'll be very much the pivot in the afternoon, is that President Harker is going to talk about things they're doing at the Philadelphia Fed, looking at the transaction system and how people are using it. And back in 2017, that was one of the core topics, the transaction system. How do you know it's secure? Who runs it? When you give your money to somebody, expecting somebody to give you something back. And then we're going to finish with a session I think ties a lot of this together. Mark Mills is going to go through his story, which is actually pretty compelling when you read it, that the 1920s could look, and the 2020s could be very much the same, that the scale of the change is so big, that what the technology enables us to do. And I just want to do a quick survey. Who has used ChatGPT? Yeah, exactly. So, and then to kind of anchor Mark down, we're going to have Leland Miller from the China Beige book, and then some people at like 2 feet in the economy, or in Laura Speak's case, underneath the economy with tractors and digging machines at CAT. All right, so that's what we're going to do. I'm going to ask Governor Waller to come up. One last thing, to get through the first session in one piece, we're going to do index cards. So we're passing out index cards. If you have questions on the first topic, write them down. We'll collect them. And Dave's going to go through them and do the Q&A. And then for sessions 2 and 3, we'll have people wandering around with microphones. And then in the afternoon, we'll do a similar thing with the microphones. So any questions before we go? All right, so I'm going to invite Governor Waller to come up. The microphone's his. In December of 2020, he was appointed to the board of the Federal Reserve System. And I think since 2009, before that, you were
St. Louis.
St. Louis.
Yep.
Okay, thank you.
All right, thanks, Steve. Well, I want to thank the conference organizers for inviting me to participate today. It's great to be back at a Global Independence Center conference. Given recent events in crypto, it's certainly timely to have a day of discussions related to digital assets. Before diving into today's talks, which will touch on various parts of the crypto ecosystem, I'd like to clearly define some concepts to ensure that we're talking about the same things. And this is the way I kind of think about the crypto ecosystem, which is, I think of it in three parts. First, there's a crypto asset, which generally refers to any digital asset implemented using cryptographic techniques that's being traded among people. The second part of this is a database management protocol used to record trades. So people are trading, you have to have some record of the trades. And this is commonly referred to as a blockchain, which includes both permissioned and permissionless distributed ledger technologies. And finally, there's technology that is designed to actually facilitate the trade itself. This includes smart contracts. Steve was mentioning tokenization as a form of data privacy. Now, if you think about those last two parts, the database management protocol and technology that allows trading to occur, these have much broader applications than just trading in crypto assets. So let's just first think about distributed ledger technology. The technology is simply a database management protocol that has various permissions regarding who can write to the database, who can read the database. And although this technology is fundamental for the creation of crypto assets, there's nothing in this technology that restricts it to being used in the crypto ecosystem. In fact, distributed ledger technology is being explored to potentially address a wide range of data management problems. Whether it is, dominates current centralized managed data systems or not, we'll find out. Next, there are various technologies related to crypto assets. One is the use of smart contracts in peer-to-peer trading. Smart contracts also can be used in conjunction with a centralized data management protocol to automate the execution of certain transactions in non-crypto assets. So again, it's a code, it's technology that could be used outside of the crypto universe. So for example, over time, these things could be used to speed up the clearance and settlement of securities transactions. Another emerging technology is tokenization. In any trade of assets, there are issues regarding how much personal information you need to provide to conduct the trade. For example, some personal information is needed to protect against the possibility of anonymous trading, which can promote money laundering. Tokenization, when combined with data vaults to securely store personal information, can be used to trade objects in a way that protects one's identity from being exploited for profit. While these technological developments are still in their infancy, they have potential applications beyond the crypto ecosystem that could lead to substantial productivity enhancements in other industries. So this leaves us with the final thing, which is the crypto assets themselves. The question is that people often ask is, why would somebody hold such an asset? What is the value proposition of such an asset? The answer isn't new or unique, but rather is based on economic relationships that result in objects having value. One reason objects have value is because of their intrinsic properties. For example, the value of corn derives in part from the fact that it can be used for food or fuel, or in some cases, a Thanksgiving centerpiece. Intuition suggests that if an object has no intrinsic value, then the price of that object should be zero. Why pay for something that has no fundamental value? Now, shockingly, it turns out that objects may be valued well above what their intrinsic properties would suggest. Since Paul Samuelson's seminal work in 1958 on intertemporal consumption smoothing, economists have known that an intrinsically useless object can trade at a positive price. Such an object's value is driven purely by belief. If I believe someone will pay a positive price for this object in the future, then I may be willing to pay a positive price for it now, carry it across time, and sell it when I need to consume other goods and services. Samuelson referred to this object, or this concept, as the social contrivance of money. Now, while an intrinsically useless object can trade at a positive price, we also know from these models that there's always a second equilibrium price for this object, which is 0. What if one day beliefs change and I no longer believe that someone will pay me for this object in the future? Well, then I clearly shouldn't pay anything for it today. So its price will go immediately to 0. Now, there are many intrinsically useless objects that still have value. Consider things like baseball cards and celebrity autographs, which are pieces of cardboard and paper with pictures or scribbles on them. Based on their fundamental properties and intrinsic value, these things have no fundamental intrinsic value, yet they can be in high demand and command staggering prices. What happens if one day no one wants to collect baseball cards? As valuable as they might be today, they won't be worth very much if that happens. So this brings us to crypto assets. To me, a crypto asset is nothing more than a speculative asset like a baseball card. If people believe others will buy it from them in the future at a positive price, then it will trade at a positive price today. If not, its price will go to 0. If people want to hold such an asset, then go for it. I don't care. I wouldn't do it personally, but I don't collect baseball cards either. So, however, if you do buy crypto assets and the price goes to 0 at some point, please don't be surprised and don't expect taxpayers to socialize your losses. So the upshot of this is that crypto assets are risky, and many of the firms dealing in them are in their infancy in terms of trading and learning how to manage them. That has come to bear in the past year as several prominent crypto-related firms have filed for bankruptcy, including payment platforms, exchanges, crypto lenders, and hedge funds. The declines in crypto asset values and associated business failures have led to many investors in the crypto industry getting hurt. Now, as I mentioned in a speech last summer, surveys conducted indicate that somewhere between 12 and 20% of US adults have owned, traded, or used crypto assets. As losses mount, the debate is turning to whether there should be better investor protections in place. But even institutional investors with significant resources to conduct due diligence of their investments have felt the pain of the so-called crypto winter. For example, it has been reported that at least 15 public pension funds, which manage public employee retirement funds, had investments in the now bankrupt crypto asset exchange, FTX. Now, while I don't care if people take on risky investments or engage in risky business ventures and other financial, banks and other financial intermediaries must engage in any activity they do in a safe and sound manner. So I'm supportive of prudent innovation in the financial system, while at the same time concerned about banks engaging in activities that present a heightened risk of fraud and scams, legal uncertainties, and the prevalence of inaccurate and misleading financial disclosures. As with any customer in any industry, a bank dealing with crypto customers would have to be very clear about the customer's business models, risk management systems, and corporate governance structures to ensure that the bank is not left holding the bag if there is a crypto meltdown. And banks considering engaging in crypto asset-related activities face a critical task to meet the know your customer and anti-money laundering requirements, which they are in no way are allowed to ignore. So far, spillovers to other parts of the financial system from the stress in the crypto industry have been minimal. The lack of spillovers to date may be attributable in part to the relatively limited number of interconnections between the crypto ecosystem and the banking system. So while it is critical that we ensure that the financial stability risk associated with crypto assets are mitigated, it is important that we keep the various parts of the crypto ecosystem distinct in our minds as the debate about if and how to regulate crypto rolls on. Doing so will ensure we do not unduly limit the development and potential future uses of the positive features of the crypto ecosystem. So with that, I'll stop, and I'm happy to have a conversation with Dave and take questions. Thank you.
All right, I'll remind everyone that questions can be forwarded up here by writing on the index cards, and just raise your hand and hand them off to Jill. I'm going to set a couple guidelines on this. If you're interested in Governor Waller's monetary policy opinions, he gave a speech 2 days ago. You can go read that one. Or you can chase him around the table at lunch and see if he's nimble enough to avoid you. Second, specific questions about the regulatory environment or laws are probably something we should avoid in this conversation. So with that, though, ask whatever you want. So I want to start by kind of thinking about this notion of intrinsically useless assets having value, and sometimes lots of value. And of course, you've spent most of your professional career thinking about money, the prototypical intrinsically useless asset in current modern fiat world. So have you come to any conclusions about sort of what are the characteristics that make an intrinsically useless asset valuable? And maybe more interestingly, sort of what makes value sustainable for these sorts of situations or assets?
Yeah, so like I said, the economics profession, those of us who've done kind of monetary theory a large part of their life, this idea that you can take this intrinsically useless object and have it trade at a positive price, we've known that since Samuelson. The critical part is we also know there's this second equilibrium, which is that price goes to zero. And that's where people, when they talk about this, they think it has to go to zero. I can't tell you how many times I've had people tell me, these crypto assets, they have to go to zero in value. And I say, no, they don't. They don't have to. As long as people continue to believe that these things will have value in the future, they can go on. So, but they could go to zero. I'm not discounting it, but it doesn't go to zero with a probability of 1 necessarily. As Dave pointed out, in a modern fiat currency world, most of these objects trade at a positive price, and they've traded at a positive price for a long, long time, decades and decades and decades. The other thing that's kind of interesting about Samuelson's work was he showed that introducing this object actually improves welfare, okay, because it allows people to carry and store wealth across time in a way that maybe they couldn't otherwise. So my kind of view on this, the crypto stuff is, if you want to carry your wealth across time in this asset and take the risk that it may go to zero in value, go ahead. Just be aware that this might happen. So I don't have any, concerns or worries directly, just as long as everybody's informed that this stuff may one day just go to zero in value and you'll just lose everything. But it may not, right? That's what I said. I just look at baseball cards personally and go, I can't believe these things have the value that they have. And nobody talks about baseball cards going to zero in price, but they certainly could. If people just wake up one day and said, old, dead, boring sport, we don't care. And that could be the end of it.
So one interesting development in cryptocurrencies was the stablecoin idea, which I sort of always took as a business model designed to keep assets from going to zero. So I guess we should start kind of in the spirit of providing a baseline for conversations with, describing what a stablecoin is, and then give us your thoughts on some of the recent developments maybe that suggested the volatility that was supposed to be solved by stable coins wasn't really solved, it doesn't seem.
Yeah, so I always look at, so if you looked at the crypto ecosystem before stablecoins, these things could go up in value, they could crash in value, there was nothing. And people that were in this world trading, they wanted to be able to move into, say, a risky, volatile price crypto asset, but then they want to move back into something safe. Right? Just like people want to buy stocks and move it back into safer, say, treasuries. But there wasn't anything in this ecosystem, particularly, say, in the Ethereum rails, that looked like a safe, liquid object like a US dollar. So this is where I love markets. Markets said, we'll invent one. So you want a stable asset in the trading on the Ethereum, rails, we'll create something called a stable coin, which is we give you a crypto asset that does have a quote unquote fundamental value. We're going to tie it 1-to-1 to a US dollar. And then because it's tied to the dollar, this price doesn't change as you trade, go in and out of various crypto assets. So stable coins arose, in my view, as a response to the demand for a safe liquid asset in the crypto ecosystem. And that's where the market provided it. They created stablecoins. Now, the thing is, there isn't just one model of a stablecoin. So a stablecoin is, you give me $1, I will give you this object, kind of like a poker chip at a casino, and it will give you, and if you bring it back, we'll give you exactly $1. We'll give you no more, no less, no interest, no nothing, just we'll give you your $1 back. Now, you'd have to say, okay, what's the value proposition of issuing such an object? It's clear there's a demand for it, but how do you make money out of issuing a stable coin? And that's where I think there's a lot of different ways people have done it. The kind of standard model, something like US dollar coin, you give us your dollars, we'll issue you a stable coin, and we'll take the dollars and go buy safe, liquid government assets. And then we'll hold on to those, and if you need your money, we could sell those very quickly, get the money, hand it back to you. The problem with that model is it always has run risk. There is a chance that everybody comes in and says, look, I want my money, and you have to sell these assets and you can't sell them fast enough. And that's kind of the problem with that basic model. It always has some run risk. It may be very small, but it's still there. Alternative models would be like, when Facebook was still talking about DM, the last model they had was, you give us $1, we'll issue a DM, we'll take that $1, we'll put it right in a Federal Reserve account. We won't buy asset, we'll just put it straight into the Fed. So it's backed 1-for-1, it's sitting right in the Fed. Now, what's the value proposition for that? Well, what Facebook wanted was people to use this thing on their network and get your financial data. So their profit was not in actual issuing or interest arbitrage, it was purely, we want your financial data, and so if you're willing to give it to us, we'll do all this stuff for free. So that's the thing, there's different models. Then you have the weird ones, which are the algorithmic ones, which are like, we're gonna write a computer program to say, we're gonna issue this stable coin and some other crypto asset, and they'll trade to always keep the price constant. Well, if you believe one of them's going to zero, the other one might go to zero as well and suddenly not a stable coin anymore. That was the whole Terra and Luna fiasco last summer. So even during all the crypto, there were stable coins that actually the demand increased during the crypto meltdown. People wanted to move into this safe liquid asset in the crypto ecosystem, and they moved into it. And so instead of actually crashing, these things went up in value and had to be minted to bring the price back down to $1. So that's what we'll see going forward. We'll see which of these things survive, which ones won't, what's the best model, how do you manage these kind of run risk. And I think it's just a market innovation to give markets what they want.
So
sorry,
like every
long-winded answer.
Long-winded is good. Minimizes my work. So I guess like anything else, there are good business models, there are bad business models,
exactly.
and the technology doesn't really kind of point you to one or the other.
Right.
Right. So the next session after this one is going to be about decentralized finance. You didn't mention that in your remarks today, but you gave a speech, I think, in Switzerland not very long ago, where you did talk about it a lot and noted that, in the the crypto world started off as sort of this narrow payments-related device or innovation to something much broader. So just quickly, I mean, well, I don't mean you have to be quick, but what's your sort of definition of decentralized finance, and more importantly, how does that fit into your comments this morning?
Yeah, so I think the original intent for DeFi was to trade in these crypto assets. So Bitcoin pops up out of nowhere, and then all of a sudden its price goes up above zero, and it just keeps going up, and people are all, interested in buying Bitcoin and trading Bitcoin. But then others said, hey, we can issue something ourselves. We don't, Bitcoin's not the only thing that could be issued and traded, so we'll issue our own coins with some other model of doing this. So then the question is, how do you do these trades in the crypto ecosystem? And the real thing with DeFi was the intent was to be decentralized, no intermediaries. It was peer-to-peer trading. And that was really what they meant by decentralized. And it was a world in which you didn't trust an intermediary, you didn't really trust anybody else, you trusted code, right? This is the joke in DeFi. Code is law. We don't need lawyers. The code is the law. So that was the original idea, but then of course what starts happening is intermediaries pop up, platforms pop up to enable you to kind of move in and out of these things. The minute you bring in an intermediary, you reintroduce the need for trust. You just can't avoid it. So the original DeFi was a world of no trust, peer-to-peer trading. The minute platforms come up, you're back in an intermediary world where you have to trust. For example, customers of FTX trusted that their coins were there. Well, they weren't. And that's exactly where the DeFi world has kind of moved more into looking more like, we have intermediaries, we have to trust them, they do this on our part. And so it's kind of moved away from the true original intent of DeFi, where it's just pure peer-to-peer. Now that's still there. It's not that it has gone away, but you're seeing more traditional financial models and products coming into the crypto world.
So speaking of the evolution of things, you mentioned that in your discussion of tokenization, another topic for the day, that there are going to be new, innovative, increasing uses for tokenization. So what did you have in mind when you
I
made
think
that
sometimes
comment?
it sounds, but if imagine you were trading an object in a platform that was coded in Fortran, and now there's another platform coded in Python. How do you move these digits from this completely different computer language over into this one? Well, this is one way that tokenization helps. You say, okay, I'm going to create this object in the new platform. It's going to be linked to something in the old platform, and then that object in the old platform gets locked down. It can't be used for anything else. So that's one way to think about tokenization. It's a way to kind of move, it's like I said, the casino. You go to a casino, you take your paper dollars, you hand them there, they give you a token. It's called a poker chip. That's it. That's the simplest form of tokenization you can think of. As Steve said, it's just a record. The casino chip is just a record that you have a dollar somewhere that you can get back. So a lot of tokenization is that, and because these new platforms are not restricted by the old way of thinking. So a lot of trading platforms are designed to work Monday through Friday because of the human life of we don't trade on the weekends. Well, there's nothing that says you can't do that. These new technologies say you can trade continuously 24/7. But that's a different platform than what we're set up with our bank accounts or our security accounts and all that. So there's a need to say, how do I take my securities that I'm holding over in some account with an intermediary and allow me to trade it over on this 24/7, 365 platform and then go back into the other world. So that's one way I think about tokenization, is that it allows you to move across different platforms that give you some advantages that your current platform doesn't give you. And we know that banks are working on this already. They're looking at doing securities trading, all these kind of things. Repo is being done by some of the banks. And then the question is just how do you do all the record keeping? Is it centralized? Is it decentralized or distributed? And that's what firms are working out. They're trying to see what they can do with it.
I think there's a related question that came in from the audience is making the observation blockchain is broader than cryptocurrency. So there's a direct question. Would you agree cryptocurrency is dependent on blockchain technology, but blockchain is not dependent on cryptocurrency?
Yeah, so that's the fascinating thing. Years ago, we had a conference at the St. Louis Fed, and it was on crypto and that. And I made this claim to all the people in the audience that in terms of the crypto asset, there was nothing interesting to learn. We already knew everything from monetary theory, which I talked about a little bit today. The fascinating part was this way of doing record keeping. The traditional model in the world for centuries has been there is a trusted record keeper with a set of books, in the old days a piece of paper and you wrote it down. And that this centralized record keeper took care of everything, but not everybody could write to the book and not everybody got to read the book. So then you come up with distributed ledger technology and blockchain, which is everybody can write to it, everybody can read it. And this was an astounding revelation in terms of technology. Now, it has some issues in terms of how you verify transactions. They may be very costly, maybe not environmentally friendly or whatever you want to say, but they're a way to think about how a group of people could jointly manage this record-keeping database, adding entries and reading entries that maybe could be potentially very efficient. So you don't need to think about distributed ledger strictly in the crypto ecosystem. You could do it managing, and I've heard examples of firms for doing shipping, keeping track of when something has been put on a ship, taken off a ship, put on a truck, moved over there. There's a record base that everybody can see that this object has been moved across. It has nothing to do with crypto. It's just keeping track of data. And that's what I really want to stress. Blockchain and all this stuff is just a data management protocol, and anything that requires data management could be done this way.
So here's another one. It sort of relates to my first question. What caused the rise of cryptocurrency?
So, if you go back to the original Bitcoin, the original intent of Bitcoin was we want to create an asset that can be traded all over the world, and this is the critical thing. It's censorship proof. No government can take it from you. No government can erase the records that you have this or hold it. That was what Bitcoin was designed to be. So it had this kind of anarchist, libertarian, but if you're in a country where you don't necessarily have a stable government or you're worried about your property rights or having your wealth confiscated, this might suddenly look like a pretty decent asset to take a risk on. So that was the original intent of Bitcoin, was to create an asset that could be stored and never taken from a government. And you can trade it anywhere in the world with anybody else. In that world, you're not worried about how do I make efficient payments. That's not the objective. The objective is to make it censorship proof, period. And that's a different animal than thinking about it as a true payment instrument, which everybody talked about with Bitcoin early on. Oh, it's going to compete with Visa and MasterCard. No, it's not. That's not what it was designed for. It's not supposed to be an efficient mechanism for this. But if you want to think about something like Ethereum, which has moved from proof of work to proof of stake, there are better, more efficient ways to think about validating the trades that could be cheaper and more efficient and lead down the road.
So let me go to where you sort of concluded, I think, on your remarks about the various risks that have to be managed. That, include things like fraud and bank runs and the sort. Is there anything unique about the crypto world that does not fit into the usual categories of risk in financial markets that we typically think about?
Yeah, a lot of what we're seeing is, fraud is fraud. It doesn't matter whether it's in crypto or it's, so my friend Alex, who was supposed to be here, always says, if you give $1 to the banker and the banker runs off with the $1, you're not going to blame the dollar. You blame the banker, you blame the intermediary. And he said that's the same thing in the crypto world. The crypto asset is it's just an asset. It's neither moral, immoral, legal, or ethical, or it's just an object. It's the trust you put in the intermediary to do things for you that's where the problem comes from. So those intermediaries got to have proper corporate governance, proper risk management, proper transparency, and that's what right now in the ecosystem of crypto, those things are still being developed. They're not always great, as we've found out with a lot of these firms, but that doesn't mean they won't get there. They'll grow, they'll mature, they'll get there, and when that happens, there's a lot more ability to think about interacting crypto into the traditional financial sector.
So thinking about the role of crypto in the payment system, there's a question that there's a lot of systems like Apple Pay, and PayPal. What makes crypto different in these applications and in this context?
Yeah, there's a distinction between, how you do payments and then what's the object that's being used for payments. Most of the payment systems we have use the US dollar as the unit of account and the object that's traded. It moves from your bank account to somebody else's bank account through these networks. Crypto is just a whole different set of rails. It's not tied to Visa, MasterCard, anything. Ethereum has its own platform. People can use it to trade these objects, but what do you pay with? There are no US dollars directly on the Ethereum network that can be traded. There are no bank accounts. There's no transfer from bank A to bank B. So that's where stable coins come in as some stable unit of account to do these trades across these different assets. So, you always have to, like I said, you have to kind of separate the payment system from the object that's being used. You can use any kind of object, but the payment system is giving you either efficiencies or speed or anything that, whether it's a US dollar, a stable coin, or a bank deposit is kind of irrelevant for just talking about payments.
So would you say that's a general theme of your thinking about this, that this is a lot of very old stuff in a new package, and just figuring out what that new package is the real unique part of this?
Right, and that's why I said the crypto asset stuff to me is, we know all that. There's really nothing I've seen from a crypto asset that I think is fundamentally new or interesting. But the technology is fascinating. And that doesn't have to apply to crypto. That's what I think has kind of been the most, I've said this, like I said, about 5, 6, 7 years ago. It's the technology that has some amazing ability to do things and do it well and do it better. And I think you're going to see this more and more coming into centralized finance. The crypto assets may never be there, but the technology will survive and go forward.
All right, we can't avoid this because I have a whole stack of cards asking about central bank digital currency.
Okay.
And I know you have a lot to say about it that you said. I mean, I guess, everything that there is to be heard is out there, but not everyone has heard it. So what is your, first I'll ask your take on central bank digital currency, and then maybe sort of describe where the Federal Reserve in particular is sort of engaged in that.
So the first thing is, what is a central bank digital currency, and what would the Federal Reserve be considering doing? It's not Bitcoin. It's not some anonymous bearer instrument that can be traded like a US dollar bill anywhere in the digital space. What is being explored is what's called an account-based CBDC, which would basically mean you have an account at the Federal Reserve just like you have a bank account at your bank. Now, there's 2 ways you could do it. You could have a direct access CBDC where you call me up and say, hey, Chris, send some money over to Dave through the Fed. Or you could say you have an account at a bank. It's just, there's your checking account, right below it, it's your CBDC account at the Fed, and you would tell the bank, hey, go tell the Fed to move some money out of my account to Dave's. So what we're talking about are account-based payment systems. We're not talking about some anonymous bearer instrument. That's not what's being considered. Now, the key thing is, when you introduce this, you're saying we're going to create accounts for payments and trading that compete directly with the banks in the US. That's basically, at the end of the day, what you're doing. So I always pose 2 questions. The first question is, what is the major market failure in the current U.S. payment system that a CBDC and only a CBDC can solve? I posed that question about 1.5 years ago. It has not been answered yet, anywhere that I'm aware of. The second thing I take about this is that when Congress created the Fed, they gave us the responsibility for a safe and efficient payment system. And the model we adopted was, we will let the banks be the front-facing part of the payment system to deal with customers, and our job will be to sit in the background and make sure that the payments clear and move back and forth across the banks. So we were not at the front of the house, we were at the back of the house. With the CBDC, you are now stepping up to the front of the house where we are going to engage with the retail customer directly. So I want to know what is wrong, what happened that the old model is no longer the right model, and that the Fed needs to be forward-looking and directly interact with retail customers. Again, I haven't received very good answers to why we need to do that. So for that reason, I haven't been a real big fan of CBDC. It could be in some countries it's valuable, but for the US, I just don't see the value proposition of it.
Yeah, we have a question that's actually related to that, so you may not have more of an answer than what you just gave, but you know, are there environments kind of globally in other countries that make central bank digital currency more sort of plausible or more effective or efficient than in the US case?
Right, so as I've pointed out that, you know, in basically US and Europe and most of the major countries, you have a very well-functioning banking system. It works very well for the most part. There's some inefficiencies that could get sorted out, but that's mainly to do with payments, how to do the payments more efficiently, not create a different object to use in payments, which is what people are talking about with the CBDC. So I don't really see a big value gain from doing this in kind of countries that have very well-developed and stable commercial banking systems. If you're a country that has kind of a bad financial or weak commercial banking thing, and the central bank is safer and more trusted than your commercial banks, then I could see the value of doing so. But you know, like in Africa, there are places where they trust the telecoms more than they trust the central bank. So what, I want to move my money across my phone company. I don't want to go to the central bank or my bank. So it's not clear what you're going to pick up and do in those worlds. So everybody's exploring it, everybody's looking at it, everybody's trying to figure out how to do it. To date, I just haven't seen the value proposition for large, well-established countries with very good commercial banking systems.
What sort of things are actually happening in the Fed to kind of monitor this and maybe broader than just the
right.
CBDC?
So I have to say that I believe, and I think we've taken at the Fed at this point, the proposition is it's not the responsibility of 7 unelected officials to make a decision to issue this. This should be coming from Congress. Congress should say, we want the Fed to issue or not issue a CBDC. Now, in that world where I've just shoved the responsibility onto Congress, they may come back and say, hey, Chris, guess what? We want you to do it. And I'm going to say, yes, sir. Okay, that's my job. You tell me to do it, I will do it. But then you have to think, okay, how are you going to do this? What is the technology? How are you going to actually do this thing and make it work? Because it's really the central banks are getting directly into the payment system in a way they've never done before. So we have to think about technology. How would we do it? How would we clear? How would we settle? How would we track? And so what we're doing is we're doing research and development and thinking about how we would actually do this if Congress ever comes to us one day and says, we want you to do it.
So I think there are some examples. I mean, like Sweden, I think, has been pretty active in this. Are there Go ahead.
No, go ahead.
I was going to ask, are there lessons with respect to the things they're engaged in, or is just the environment so different? I mean, I think your comment just a second ago was, state of your financial system really matters for this, this question.
Yeah, so that's really it, that goes back to this question. What is the fundamental problem in your payment system that requires this thing to be created and used? you get some kind of offbeat kind of comments, but I just don't find that convincing to have the Fed, for example, step into direct competition with retail banks. I don't, that's not how I think this is my capitalist view, that we let the private sector deal with these things, and it shouldn't be that government agencies go and directly compete with private firms. As much as you might like electric cars and as much as you dislike how high prices of Teslas are, I don't hear anybody saying the government should start producing electric cars to drive down the price of Teslas. We don't do it in anything else. So I wonder, why do we now think this is the time we want a government agency to go out and directly compete with the private sector? And why is it this object? Why is it this issue?
I gather that you think the possibility of digital cash, in the sense of it, something that gets traded anonymously, truly anonymously, is a dead letter. No one's
I haven't heard one central bank seriously talking about doing this. You already are worried about tax evasion, money laundering, terrorist financing, and you're going to create something that makes that even easier? I can't see too many governments saying, yeah, that's what we want. We want to, at least with physical cash, you got to have a suitcase. you got to meet in a spot and swap the suitcase. I've seen this in a lot of movies, but in a digital world, there's no physical restraints on how much could be traded or moved and at the speed of lightning with anybody. So I don't think, you already have people saying we need to get rid of currency for these reasons. Mm-hmm. Why would you create a digital version that's even better at doing all the things you're trying to stop? So I just don't think governments really would ever want to have some anonymous object, bearer instrument that can be traded instantly around the globe in really large quantities.
I think this was sort of the original notion of Bitcoin, though, right?
That was Bitcoin. It was to get away from governments and not have you take it. Now, there's lots of other things that happen with Bitcoin. There's lots of really stuff we don't necessarily agree with starts happening in trading using Bitcoin as the payment instrument or the asset that moves across time. Any kind of ransomware. We don't think this is something we should facilitate the ease of payment with by creating a digital US dollar that way. So that's what I mean. That's why we've looked at mainly these account-based models and not a tokenized anonymous bearer instrument. And we're looking at, could you do that in a way that's not anonymous? There is some record keeping. We do know who's involved, and you could trade this thing. Yeah, we're kind of looking to see if that's possible. Okay.
So I think we're getting near our time. So let me ask you a kind of final question. If you, try to distill your thinking as much as you can on the crypto ecosystem broadly, what do you think are the greatest risks, and what do you think are the greatest promises?
Yeah, so I'll go back to the thing. All these crypto assets that are being traded, they're intrinsically useless objects. I mean, you have a stable coin, which is supposedly backed by $1, so that's its intrinsic value. So the risk is these things go to zero in price. So for example, we don't let banks get into collectibles. We don't let them hold art. We don't let them hold all these kind of things that have these potential speculative things where the price goes to zero. Limited edition sneakers. We don't want the banks getting into that stuff. That's the thing you have to realize with these crypto assets. There's a price at which it's an equilibrium where the price is positive, and there is an equilibrium, it goes to zero. And so that's an incredibly kind of risky asset. We don't allow banks to do it with other kinds of things that have these properties. So if you're going to let crypto in, it's got to be, very carefully watched and taken into account. So the crypto assets themselves, like I said, I don't find them particularly interesting. You can play with them, you can trade them, you can do whatever you want, knock yourself out. But the technology is what's fascinating. And I really think the technology that has come out of Bitcoin, like I said, the astounding thing with Bitcoin was the distributed ledger, the blockchain. The fact that you came up with this digital object that moves across people, who cares about that? That's not interesting or new. But the blockchain was a fascinating technological idea that actually works. There's a lot of ideas that people come up with, they don't really work, but this has worked. Now, again, the punchline at the end of the day is, does this technology in the crypto system have a value proposition outside of the crypto ecosystem? And my view is let's find out. It may and it may not, but let's give it a run and see where it goes.
Are there any particularly novel applications that you find particularly interesting, or you think it's just
Well, I think
not that focused yet?
Yeah, I think, like I said, I think tokenization is an interesting way to think about people being able to trade objects that they can't really trade now in the current frameworks that they're in. But you want to be able to put those things on a new platform and allow people to kind of trade them. That, I think, could be amazing in the sense of doing it. Smart contracts could be an incredibly efficient way to say, look, here's a contract, it's written in code, code executes, it's done. There's no, well, wait a minute, I'm going to go to my lawyer, I'm going to go beg for somebody to say, hey, I didn't really mean that trade, give me my money back. Sorry, these things are efficient in terms of finalizing trades. You may not want that. There's lots of people who say, look, I always want the chance that I can undo the contract, right? That's a human nature, and there's always going to be people that say, I don't want to deal with these smart contracts because there's so much finality when it's done. But that doesn't mean it can't really be useful in a lot of day-to-day trading where you're not worried about litigation or other things.
Please join me in thanking Governor Waller.
So if I'd thought ahead, we would have renamed the next session
I just want to grab myself.
tokenization. A lot less words than DeFi versus, what was it? I can't remember the original. So coming up is Jim, Will, Don, and Anthony. All right. Oh, I was going to try and steal his break. Can we do that? We'll take a little, who wants to take a 10-minute break? I do. We're going to take a 10-minute break.
Okay, welcome back everyone to our session 2, Decentralized Finance. What is DeFi? Why does it matter? I'm Don Rissmiller. I do economic research for Strategas out of New York City. I'm happy to be here. I'm also a GIC board member. And I'm joined by a great panel today. We have 𝗵𝗶𝗀𝗁, Head of Digital Assets at WisdomTree, 𝗤𝗵𝗿𝗶𝘀𝘁cie, Head of Asset Allocators at Coinbase, Jim Bianco, the President and Macro Strategist of Bianco Research. So to start off, we'll have some opening comments from our panel members. Tell us about yourself, tell us about your firm, and any opening comments for today's session. So Jim, I'll turn it to you.
So I'm Jim Bianco. I'm macro strategist of Bianco Research in Chicago. So I do more traditional, what they would call TradFi research. But about 6, 7 years ago, me and the guys I work with who are here tonight, we fell down the crypto rabbit hole, and we've been playing around with this space for a number of years, getting very deep into the whole DeFi and into the whole space. And we still think that it has a lot of promise, and it has a lot of opportunity to be the disruptive force in the financial system that everybody hoped it would be when it was first created. Now, it's had some stumbles along the way. It's having another one now, but all types of technologies and all types of disruptive forces go through this, and this one is as well, too.
Just thank you for having us. Thank you for having me and Coinbase here at the GIC. It's really cool to see everybody in the room. My name is 𝗤𝗵𝗿𝗶𝘀𝘁cie. I lead the asset allocators business at Coinbase. What that means is I'm responsible for all the relationships with our LPs, limited partner investors. They are endowments, foundations, family office, single multifamily office platforms, all the way up to some pensions. Those investors are investing directly in digital assets, some of them, and others are investing in active managers, actively managed strategies. So part of my role at Coinbase is to manage those relationships for access to the platform in different ways that they do at Coinbase, and also get introductions to managers. I'm leading our tokenization efforts, which we'll talk more about here today. I'll share just a little bit about Coinbase, just so everybody knows. Coinbase is not DeFi. Coinbase is a centralized exchange and custodian prime platform. And so, all of the stuff we're going to talk about, most of it today around DeFi, is going to be separate from what Coinbase is. What Coinbase does, though, is we are a gateway. We're an access point. We're an infrastructure layer for users who want to access digital assets, trade them, or access the DeFi infrastructure rails directly. So they use our wallet infrastructure. Coinbase has, we're the largest US exchange. We're a publicly traded company. We are, the custodian has about 100 billion in assets under custody, and we offer a traditional prime platform for hedge funds and other managers to access trading strategies. Thanks for having me.
Good morning, everyone. My name is 𝗵𝗶𝗀𝗁. I'm head of digital assets at WisdomTree. I want to thank the GIC and Steve for the kind words earlier. WisdomTree is an asset management company. We manage close to $90 billion in assets today. Increasingly, we've been focused on digital assets, blockchain, tokenization. Today, more than ever, plenty of banks, asset managers also have heads of digital assets focused on stuff like this. We were a little bit earlier than many of them, which I think has been helpful now. And I can touch more on in the session what exactly we're doing in this beyond just kind of crypto per se.
Well, thanks very much for being here and contributing to the conference today. Why don't we jump right in? Jim, maybe I'll go to you. What is DeFi?
So to answer that question, I think I got to put a nuance in something Governor Waller was saying earlier today as well, too, is that there's centralized finance and there's decentralized finance. And we do want to separate the two. As Anthony said, Coinbase was centralized finance. FTX was centralized finance. I'm not trying to put you in the same bucket with them. Yeah. And then there's Kraken, Gemini. These are centralized finance organizations. We want to talk about is decentralized finance. The names that they go by, the phraseology we use is we refer to centralized companies as platforms and decentralized companies as protocols. The protocols that you might be familiar with are Uniswap, SushiSwap, MakerDAO, Compound, Curve, Aave. These are some of the bigger names in the space. In decentralized finance, they are run purely by open source code. They're run by smart contracts that execute code, but the code is open source. It is not a secret. You can go and you can audit the code. You can see how the code exactly works. And in decentralized finance, there is a limited set of information that is required from the other party. I don't need to know your name. I don't need to know much about you. And now that they've brought up zero-knowledge proofs, or ZK proofs, I don't even need to know much about your account. All I need to really know is that you have enough information to know that we can exercise the other side of the trade. So in decentralized finance, it is run automatically, it is run decentralized, it is permissionless, it is censorship-proof, it just works. And by the way, that's one of the things that we have found throughout this winter. The firms that we have seen problems with, the Celsius of the world, the Three Arrows Capital of the world, the Terra Lunas, the FTXs, these are all centralized firms that were modeled after the existing financial system that failed. But a lot of the decentralized, in fact, almost all of the decentralized firms have not. They have worked, and they have worked properly to show as a use case that decentralized finance can work. I'll stop there. We'll talk about it more later.
So what is DeFi? All right, I guess DeFi, in my view, at the firm, is it's permissionless open source. There are permissionless open source protocols that allow you to transact value or move value on a public ledger. And so I like to compare it to, our roads out here are maintained by government funding, and that's a centralized activity. We get tax dollars. There's other revenue streams that goes back and it builds roads, and we all benefit from the access. Nobody's checking you to make sure that you can access a road, right? Maybe you pay a toll here and there. If you go too fast, you get a ticket. And so public ledgers, open source public ledgers, are exactly the same thing, where it's a permissionless layer for value to move. So anybody can come onto that road, and they can move a Bitcoin or an Ethereum or a Dogecoin or whatever it is from A to B, from A wallet to B wallet. They can also participate in financial primitives, right? So these primitives are some of the lending protocols that Jim's referring to, where they can earn interest on an asset. They can be a participant in a automated market maker liquidity pool. And what that does is it allows for market making to exist where it never was before. And so if you have two assets and there's no liquidity between them, you want to create a market. So in traditional finance, we have market makers, we have broker dealers, there's a whole process around that, and there's a lot of intermediaries in between. In DeFi, it's just code. And so you go into a pool, and as long as there's liquidity in the pool, then a buyer and a seller can match, and they can exchange their asset. So DeFi, I think the important thing is it's meant to be decentralized, permissionless, public infrastructure. And if it's successful in that and maintaining the public infrastructure, then we can build a lot of really interesting things on top of it that power a lot of the real world use cases that we'll talk more about today.
I don't have too much to add on two great definitions, or really definitions that were very in sync. I guess the one point I'd make is that a lot of this is a spectrum in a certain sense. Decentralization is a spectrum in terms of which protocols out there that are truly decentralized. I think the term DeFi has become a little bit of a term of art. Some people are starting to say, oh, institutional DeFi or responsible DeFi or different things, which might be using these same sort of software protocols, but in more regulated, overseen, and intermediated ways, which, maybe it's not technically DeFi, but I think as a term of art and kind of an idea of trying to use this technology to make financial services better, it still works. So that's the only thing I'd add in terms of how I think we're seeing a lot of the term DeFi being used today.
We should also highlight too, DeFi is one sector, right? It's probably the most prolific sector in all of crypto, but there's also other concepts around decentralized science. So DeSci. So this is it uses the same framework of how do you use community incentive mechanisms to enable engineers to build models on health data sets, right, and reward them for doing so. There's other concepts called decentralized social media, which is how do I own my data when I'm interacting with a social media platform and move my data from one platform to another, so I'm not tied to Facebook and Twitter. I want to take my users to a different platform. Decentralized social media is powering the ability to own your asset and move it around for you. And so if you think about that concept of using these public layers, the public highway, that's decentralized and permissionless, and then you can go sector by sector and create versions of decentralized sectors that we have today. And we think it will kind of continue to blossom throughout every sector in different ways.
So let's move on to another word that came up earlier, which is token. So this is Steve's work. Steve found an Old English definition from 890 AD of a token that is something that serves to indicate a fact, event, object, feeling, a sign, or a symbol. However, if you search for tokenization, you get a blank sheet. Right now is nothing that shows up. So maybe I'll go to Will. Token and tokenization, what should we know?
It's a great question. I'll start off with a bit of an anecdote of back when Facebook, or Meta was Facebook, and when DM was called Libra at the time. You know, they put out this initial white paper talking about this model for a new type of currency called Libra that would have, you know, essentially big institutions. Libra itself would be a basket of other currencies and short-term bonds and things like that. Institutions would be able to create new Libra or redeem new Libra, and that was kind of the model of how it worked. At the time, there was an ETF blogger I really liked, 𝗣𝗵𝗿𝗏, who wrote a blog post saying, you know, actually this Libra thing looks a lot like an exchange-traded fund, an ETF. And not only that, it looks a lot like this very specific WisdomTree ETF, the WisdomTree Emerging Currency Strategy ETF. And at the time, I was already working on this, right? Like we had already kind of made up our mind that this was actually something very relevant for our business as kind of a well-known, you know, exchange-traded fund sponsor. And I just thought that was a great example of kind of, you know, how these things are converging and I mean, really what a token is, it's just a record, right? I think we get kind of hung up on stable coins, or people do, but I thought, you know, the previous conversation got to really the heart of the matter. It's just e-money using a different database. So instead of Venmo, you know, where PayPal or Venmo have their servers saying that, you know, Anthony's got balance X, Jim's got balance Y, and it's all kind of stored on Venmo's own servers, here you're just saying, well, we've got this new form of e-money where me, an issuer of a stable coin, saying, well, I'll redeem that for $1, but the value is recorded on publicly available permissionless or permissioned or whatever databases. So that's how I think about e-money and this concept of a token. And there's no need to stop there, right? This is the same set of infrastructure, the same set of standards. You can apply it to lots of different assets or types of things, including funds. So a lot of people have pointed out, oh, stablecoins look a lot like, you know, money market funds or things like that. We saw that as well, and we actually, like, you know, regulated firms went to the SEC and said, hey, we want to do something like this, where we've got this great floating rate note strategy. You know, U.S. floating rate notes, you know, no duration government paper, yields 4.5% today, right? A great investment vehicle given the time. Why can't this vehicle be in something that can be recorded as a token? And that was, you know, 3 years ago. So it takes a long time to kind of get these things done, but where Steve referred earlier, we're tokenizing strategies or products. That's exactly what we're doing, but it's really just making a record of something available in this new database, which has lots of, you know, implications and use cases, some of which people might think are not great, but a lot of innovation and, you know, market structure is trying to develop that.
So you might tokenize something even that itself is liquid, like treasury bills. That would be possible.
Why not? I mean, if people find value of it, and it's incumbent on us to kind of demonstrate those use cases. I mean, one that I like to focus on is this convergence of savings, investings, and payments, where what you're seeing, like some people look at Bitcoin and say, oh, it's a payment instrument because it's really settlement instrument in terms of I can settle on a peer-to-peer basis, but I can also hold, well, why can't you do that with other things, right? Like, why do we need to wait 2 days for the security system to settle right now? There's no reason that needs to be that way, right? There's lots of ways that you can, it doesn't need to just be blockchain. There's lots of ways you can try and improve upon that. One of which we think could be, you know, blockchain-based infrastructure.
I would just add to that when we talk about tokens, what we're talking about with the technology of the blockchain is a whole new concept of private property money. All money has been issued by the state or the government, and it's been backed by the state or the government, and it's been held in financial institutions that have been regulated by them. And the new experiment we're trying to do is we're trying to get back to a system where my tokens in my wallet are mine. And they're not permissioned, they're not censored, and I can do anything I want with them. Now, Governor Waller mentioned that, you know, there's the concern about illicit activity, and there's a concern about, you know, terrorism financing and stuff. Yeah, that's true, and we have that problem today, and we've had 20 or 25 years of money laundering and know your customer rules, and Last I checked, I don't see the Mexican cartels going out of business anytime soon. So while that is always a concern that this stuff could be used illicitly, it is in the current system, and the current system doesn't seem to be able to address it any more than we've seen in the proposed new systems of tokenization and private property money.
Can I just, I'll build on that a little bit with a little bit more granularity around what is a token. So if you look across the crypto economy today, there's 20,000 tokens out there. And, I think Governor Waller is right in that a lot of them don't have an intrinsic value. They have an expected value, right? And so you can't look at them and say this token represents a cash flowing entity underneath it, right? But you can look at them and say that the community who's using them expects it to be worth something. And so what the magic of the blockchain, the magic of tokens on the blockchain is that it was inherently a mechanism for Bitcoin was, how do I get users to use this network, right? It's, okay, I'm gonna give them tokens. So it was emitting tokens, and all of a sudden people decided peer-to-peer transaction was valuable. So they said, I wanna own that token. I can move my money anywhere around the world across jurisdictions, right? Bitcoin became valuable because of the efficiency of that peer-to-peer system. And so that same concept expanded into Ethereum. Ethereum is a blockchain just like Bitcoin, very similar, and it has a token that is a gas. So if you want to move $1 on the blockchain of Ethereum, you have to use your ETH token to pay that gas, right? And there's a limited supply of that. And all of a sudden people go, I want to build in the blockchain. I want to build on Ethereum. I want to create applications. I want to create companies. Just like engineers did in 2008 when they released the iStore, right? It's an app layer. It has a really standardized process for building applications. Fast forward 15 years later, we've got, millions of applications. Most of them don't really do anything. Some of them are games, some of them are news, right? Some of them actually created tremendous value, trillion-dollar companies behind them, right? And we have 5 billion, 6 billion people using an iPhone. And so I think of the Ethereum blockchain as very similar. It's an app layer. You build applications on it, and now though, you can have a piece of that token that has some kind of tied value to the success of that particular application or the protocol that it's built on. And so I like to say the token is an incentive mechanism. It attracts people to a network. The network, if people come to it, the network becomes valuable. And the more people that use the network, the more value accrues to that particular application or token itself in different ways. And it has other features around utility, governments, voting, community ownership, property rights that you're making the point of too. So it's this really unique asset that I guess really hasn't never existed, in the history of our world at the scale that it does today.
Are tokens automatically satisfying their criteria that they're available 24/7, 365? Is that an automatic feature because it's in the digital world and the fact that anybody who has a cell phone can use it?
So everything that you bring into the crypto economy on digital ledger technology inherits the properties of the blockchain. So if the blockchain itself is open source, immutable, permissionless, it's global, right? So as long as you have access to the internet, you could be in Africa or China or here, right? You in theory should be able to access that particular network, and therefore the assets you bring onto it should have the same properties. And then there's other little controls around the user interfaces that you use to access it, but generally the answer is yes.
How many blockchains are there? Is there any description or data on how many of these have already been created? Is it the same as the number of tokens, or is it related in some way?
We're roughly 200 blockchains, give or take. And the vast majority of the value and activity is tied up in is Bitcoin, Ethereum, and then you go down the list of different blockchains. Some of them are exact replicas of Ethereum. And so if you think about, go back to 2010, 12, right? We had the Bitcoin network, which actually had a lot of different copies, right? There were different versions of the Bitcoin network. And then come 2017, most of those went bust. You're left with Bitcoin and Ethereum. This last cycle was the Ethereum network, which proved out that you can build applications and you can build tokens and stable coins and NFTs. So some really unique technology primitives. And so, we've gone through multiple cycles of different application layers trying to prove themselves, right, and kind of garner their market share. And here we are with 200 different blockchains, but there's a pretty high degree of concentration.
I think also when we talk about the blockchains, or the L1s as we like to call it in this business, there's two other things to keep in mind about them too. The various consensus mechanisms they use. How do you settle on the blockchain? How does a trade get settled? To keep it decentralized, you want to have some kind of, you have validators and miners, and these are fancy words for the people that conduct the transactions, but you don't want to have any one group of people to have control over that blockchain. So you have some random way or systematic way that people get chosen to validate a block, and then they get paid in more tokens on that block to get it. The one that we're all familiar with is what's called proof of work. Your computer has to solve a very complicated mathematical puzzle. When it does finish solving that puzzle, you get put to the front of the line, you get to validate a block, you get more Bitcoin, 3.25 I think right now before the next halving, and then you go back to solving the puzzle. It's the solving the puzzle part that everybody complains about because it requires a lot of energy to do these puzzles. These are very difficult cryptographic puzzles that you have to solve. But the point of that is, we don't want Goldman Sachs running the blockchain. So they have to put up a server too, and they have to solve the puzzle just like I would have to solve the puzzle. And they have no more advantage over being able to settle on the blockchain than I would if I was running my own node as well. Then we've got proof of stake, where proof of stake reduces the energy usage by 99%. Instead of putting up these massive cryptographic puzzles that create a lot of energy, we then have them put up other coins, 32 Ethereum in order to be on a node on that one. And we have either a combination of when you did it, how much you've staked, and other criteria to decide among there's about 400,000 now validators on the Ethereum network that you get chosen about every 15 seconds. There's another block, and you get chosen to do the block, and you then get rewarded for doing the block so that no one can basically run this block. And that's basically what a blockchain is attempting to do. Again, it's setting itself up so that no one person or entity can control it. And that's the whole point of it. And it's all open source. All of the code, all of the technology is available to see. When you said, you could copy it, the phrase that the industry uses is you fork it. You could then, so a lot of these blockchains start off with the Ethereum blockchain or the Bitcoin blockchain. Go, well, that's pretty good. We'll just make a copy of it, and then we'll tweak it a little bit, and then we'll create a new blockchain. And that is part of the competition in this business because there's no copyright laws. This is mine. You can't use it. Everybody gets to use it in an open source kind of way.
So what if I solve the puzzle, and it's my turn to validate and get paid, and I don't do it? Is that possible, or is it because it's code-based, I don't have that? Let's say my microwave dings, I just forget to verify. I walk away from my computer.
Your computer could fail. I mean,
computer could fail.
So in a proof of work, you just don't get paid. In a proof of stake, you'll get slashed. If you're called, so the security of the network, so for today it's 400,000 different validators are operating. Coinbase operates one of the largest validators for our clients. So they give us their assets, and we act as agent, and we are a validator for them. And if we don't solve a block, or if we put up a bad block, so we try and change the transaction flow of what actually happened, then we will get slashed, and we lose money, and our clients lose money.
Slash is a penalty. So you put up these coins, and you get a penalty. They take them away from you. And the validators will then confirm. You put up a block, and then the validators will,
Everyone agrees.
Jill went to Catholic school, so they'll bless it, and they'll say it's okay, and everybody agrees that it's a proper block, and then it gets posted to the blockchain, and you get paid.
And so that keeps the public ledger, the public network up, right? And so I go back to the roads, right? It's like if all of our jobs was to go fill potholes and then someone didn't do it and someone busted a tire, right? You're gonna wanna know who didn't do their job. And it's very similar to that. So we're all responsible for maintaining that public highway. And as long as you have a diverse array of validators around the world, that system, that network stays up and people can build on it and use it as a transfer mechanism.
And the last thing I'll say about the blockchains, like you said, there's about 200 of them. They all have little different quirks, and they all have little different approaches to the things they do, and they're all application layers. And then the developers on top of that will build trading systems, lending systems, and they'll build a lot of other things. A lot of them build them on all of them if you're large enough. And some of them pick specific blockchains, and it's the competition that is spurring to see what works and what works in certain environments. Gaming is a big thing with the crypto, so maybe some of these blockchains are better, like maybe Solana might be better off in the gaming universe Others might be better off in the financial universe because of the architecture of those specific blockchains.
So Anthony, maybe I'll go to you, and just to talk a little bit, you mentioned this earlier, but if we distinguish between digital assets and crypto assets and things that can go on a blockchain, can you put physical assets on a blockchain? Does that work?
I have my house in the blockchain. We have a lot of ETF history together, so I was at BlackRock prior to this. I ran our iShares business, and so I think of the world in terms of wrappers in a very similar way. And so it took a long time from a product category for that category to go from a new innovative financial technology that now allowed people to have intraday liquidity on a basket of exposure, whether that was U.S. equities or bonds or small cap emerging market growth, right, or factor strategies or currency hedge strategies. You guys are pioneers in that at WisdomTree. So the ETF was a really novel innovation on the mutual fund category. And so we think the digital ledger technology is the next version of that innovation on financial products. And so what that means is it's effectively a wrapper. So today, most of your personal accounts and even a number of our pension clients invest using ETFs, right? And they say, I want to get really niche specific exposure in this particular asset class. I can buy X product. There's a whole bunch of products on the shelf, and they buy one item, and it's liquid, and it has good volume throughout different markets, and it does its job, right? Now expand that, and if you look inside the ETF, it has this really complex portfolio management process going on underneath it, managed by an asset manager, a fiduciary provider. And so that wrapper, though, as good as it is about as good as the traditional financial system Rails will allow for financial products. So now we're thinking about assets that a digital layer that allows for assets to have, again, fully open source 365 trading, access to multiple liquidity venues, right? And you can design a lot more. You can design a lot of really interesting things around that technology layer. So really, what we're saying is just wrap assets in this different technology layer, which is digital ledger technology, crypto, and then now those assets have new properties. They have new value. They have new features. So, we're seeing use cases on private equity funds. So private markets seems to be an early mover in terms of digitizing in a new way, because today private markets have been kind of a darling asset class for most allocators. And, we've gone through a 10+ year cycle of adding to alts, adding to alts, adding to illiquidity, adding to liquidity. And here we are where, the public part of portfolios are down quite a bit, and the private part of the portfolios haven't repriced, and we're seeing investors, they want liquidity in private markets. And so digital ledger technology is something that's going to power that, to bring liquidity, because you can wrap it on that blockchain. I'll let you talk to liquid products, because I know you guys are active there.
Yeah, I mean, Anthony had a great answer. Kind of stole mine.
Sorry.
Just kidding. No, I guess the point I'd add is I think the standardization component here is maybe the biggest deal. And one thing that it's easy to take for granted today, whereas anyone with a brokerage account can buy an ETF holding any asset class around the world. It wasn't always that way, right? Not even that long ago, but where you had to have these bespoke mutual fund, relationships with these specific firms, and it was all, very different. And then you started to see revolutions, right, with like Charles Schwab and brokerage, ultimately ETFs kind of standardizing that process where, this wrapper could hold lots of different things underneath it. I mean, what could be the next stage of that is instead of needing to do it through a brokerage account, is it anyone with a smartphone can hold a token, right? That's actually true from a technical perspective, smartphone internet access. And what else can you put inside that token? Now, I don't know that we'll ever get to a point where everything will be a bearer instrument in that way. And I think the distinction between bearer instruments and registered instruments is very important. And, I don't think we necessarily need to still improve the customer experience that way, where people can be holding lots of different things in a wrapper on their smartphone. I mean, even beyond the U.S., right, where we've got a great, well-developed banking securities system. I mean, people around the world are unable to store value in lots of different ways, and Bitcoin's obviously one answer to that. I mean, a tokenized version of gold, right, could be another version of that. So I think that's lots of the innovation and improvements in consumers' financial experience that this technology allows, and that kind of shared layer of standardization. I think unlocks a lot of that potential.
So let me take it one step further. I see how it works for digital assets, a financial asset. But you said you had your house on the blockchain. Is that right?
That was a joke, but there are houses.
There are houses on the blockchain. So let's say I want to buy your house and we're going to transfer it, and it goes through the code, and then you don't leave. What do I do?
The blockchain doesn't, a lot of, like, so we went through this cycle of supply chain logistics, you know, back in the like, mid-teens, 20s, right? And everyone's like, the blockchain's gonna solve for all these things. The blockchain maybe it counts the lettuce heads, but it doesn't actually put them in a box for you, right? Just like, you know, the real assets, like managing real assets, real estate, private equity funds, like acting as a limited partner on your LPAC and having advisory duties over those assets, if you're an investor, like that doesn't change, right? All that's the same. All you're doing is representing your ownership in a digital wrapper in an ecosystem that is either in your wallet or it's inside your custodian with us or other big custodians who are now enabling their technology to hold that specific type of wrapper as well. And so you do get other enhancements that you can build into that wrapper, and that's really why we're doing it, right? So today, if you think about private markets, it's this really clunky back-end administration process where you've got a high hurdle, so $5–10 million to go into a private equity fund, right? Minimum investment, because they don't want to manage all the thousands and thousands of small investors because there's too much cost for the lack of real value gained in an AUM perspective. If you can solve for that and minimize the costs through this technology by saying, I can really easily track 5,000, 10,000, 50,000 individual owners through fractionalizing a token of this particular asset, and I can do it and my cost is 90% lower than doing traditional fund admin, right? That's an improvement for private markets, right? You can then go solve for the cost structure, then you can start working on distribution, right? And what happens then is you go, still need KYC'd wallets, I still need permission pools, I still need good custody, right? I still need to make sure these are high quality assets that are coming into, whether they're retail or credit investors in that space. The assets themselves have to perform, right? Nothing really changes on the underlying assets from a real world asset perspective. We're just making it more accessible and democratizing access to more people.
I think that's a key. A lot of people, they're like, oh, you put it on a blockchain and then it just magically, like, you don't need to worry about like issuer counterparty risk or anything like that. That is absolutely not the case, right? You can't actually guarantee that if something's off chain, so to speak, it's a physical asset, it's a US dollar, right? You actually need to trust the person who's saying, oh no, this is worth a US dollar. And maybe the best example of this today is, the two largest stable coins are Tether, which is offshore and kind of a shady locale. And every time they go on CNBC, you feel worse about it than you did before. And then there's USDC, right, which is issued by onshore entities, Coinbase and Circle, which is a company that has publicly available financials. They've got audited financials. And so you look at that and say, I know this is just, Circle, Coinbase, Center telling me it's worth $1, but I feel much better about them telling me it's worth $1 than Tether, right? And so in that case, I don't think you can ever remove that physical part of the process, right? If you're talking about tokenizing something that exists in kind of this off-chain way, I think that issuer counterparty risk will always be there. And I think that's fine, right? Like, that doesn't necessarily mean it's a bad thing. So the house example, you put the blockchain on the house. Well, it's only good if you're actually going to follow through on delivery of the house, right? If it's backed by the state, monopoly of force saying it is. And this also gets into very interesting things you see with like DAOs, right? Where people say, oh, this DAO is going to buy the decentralized autonomous organization is going to buy the Constitution. That was kind of a thing that happened, was that last year or 2 years ago?
And then November.
Then Ken Griffin just bought it, right? Yeah, and that was kind of the whole funny thing about it.
Right, November 21.
But you go behind the scenes of these DAOs, and it's just two people in a room who are saying, well, I guess I represent the DAO, and I'm going to sign the piece of paper because there's no way to kind of have the DAO be legally enforceable. So I think that level of trust will always need to be there for bringing this into kind of real world assets, and to us, that's okay. I mean, you want the right regulation and counterparty risk management, and that's what you live with in financial services.
We expect digital identity to be a really important topic coming in the coming cycle. We think we're obviously entering the first regulated cycle for crypto broadly, right? We're seeing SEC enforcement actions. We're seeing a whole bunch of stuff there. The challenge is going to be how do you regulate a globally accessible platform or network, right? And so basically, just think of like this network that lives maybe in the stratosphere of the Earth, and people can plug their pipes into it, and they can move goods around the world. And then as soon as you bring it off the network, you've got to adhere to some jurisdiction, whether it's US or UK or Switzerland or Brazil or whatever, and everybody's got different rules, right? So now we have to start thinking about, okay, how do we take each of those individual rules around the world and actually bring them inside of the system that anybody can access and move goods around in? And so that's going to be like one of the biggest problems that we have to solve for in the crypto economy. is around ensuring there's some level of standardization so people know the rules, right? And they don't get in trouble, and that's a global problem. I don't think it's just a U.S. problem.
And isn't this where, I'm sorry, Jim, but isn't this where like blockchain can actually help solve stuff, right? Like you're talking about smart contracts and the ability to enforce compliance in kind of this more decentralized way. I mean, that's interesting and exciting. I mean, to me, it's always interesting that SPY, right, the first ETF in the US, it only trades in the US, right? Like there's another vehicle that trades in Europe that has the same S&P 500. And why is that? It's all the regulatory structures, et cetera, that go into that. I mean, in the future, couldn't you see something where the single vehicle is trading in all jurisdictions at the same time, and that just brings more liquidity to it and distribution for it? And I think that's, I don't know if that's 10, 15, 20 years away, but it's pretty interesting.
It's a great example.
Yeah, just real quick, on digital identity, there's a blockchain called Cardano, and they've been working on digital identity in Ethiopia, and they've been trying to bring up in Ethiopia that everybody can have a digital ID so they can use it for various functions within the government, and they've been seeing some success, I think, in bringing that up. But the other thing to keep in mind too is what we're talking about is we're talking about records, in keeping records in a database. Most records in a database can be done more efficiently on a centralized server. And the question is, why would you not do it on a centralized server? Because either you don't trust the centralized authority that is doing the server, or you're worried that that server somewhere down the line will be either censored or permissioned. And so that is the big debate right now in the current system. In the current system, what we're worried about, and Governor Waller asked, what's the use case for central bank digital currencies? There is one. It's an uncomfortable one. It's control. It is control that if the Fed issues a central bank digital currency with a smart contract, then Congress could say fat people can't buy sugary drinks, or high cholesterol people can't buy steak dinners, or maybe you can't buy guns, or maybe you can't buy tobacco. And we're going to start to regulate, and a central bank digital currency will make that very efficient for them to program that in. We've seen that in China with their digital yuan, that they've done examples of that too. That's the use case. What a blockchain, a decentralized blockchain, prevents that from happening if it's done correctly. Now, it can be done incorrectly, or it can be flawed, but if it's done correctly, it prevents that from happening. And that's why these cases we talk about with what goes on the blockchain, as opposed to why doesn't just one person do it on a server? Well, because we don't want somebody to come later on and start attaching rules and regulations and permissions and censorship on that, like your home. All of a sudden we'll decide that certain people can't own homes, or maybe certain people can't own homes, or we're going to change the definition of this stuff. But in a blockchain, you can't really do that. It's very difficult.
The CBDC conversation is interesting because on one side, you're right, it's about control and oversight, right? On the other side, what it espouses to do is to have the ability to have direct interference or stimulate in a more specific way. Right, and that's like a benefit, or at least it's a said benefit of it. Now you can actually do that on the public blockchain, right? So it's all open sourced. It's all you can use firms like Chainalysis and others. We have our own version of it at Coinbase, where you can literally see, you can map every single wallet across the entire crypto economy, and you know where every asset has moved and where it came from, right? So the level of transparency is to a degree that has never existed before across a financial system, and so. There's an element of CBDC that goes like, I actually think it's a good idea to be able to go and stimulate more specifically, but that you can already do that with publicly available ledger technology. So you don't need to necessarily create your own currency to do it. And so I think there's probably some happy medium in there around how the Federal Reserve would like to be able to use this technology that isn't all about the big eye of Sauron.
So we're going to come up on our time. Our panelists will be here afterwards. We probably have time for just one audience question. If there's something, I'll pass the mic to Jill. If there's one question, we can take it now. Otherwise, we'll all be around.
Who's got the question?
Oh. Hold on, we're recording. We'd love to get your question.
So this might be a little rambling, so I apologize if it's not like a coherent question. This is hard enough to follow as a non-tech savvy person. So, if you're a consumer, right, or a guy like me who barely understands the words you're using, how do I ever operate in an actual trustless system? And if I can't operate in a trustless system, by definition, I have to trust guys like you to do it correctly, right? And I have a very hard time auditing that. So then regulatory people come in and say, you have to take care of the consumer because they can't do it themselves. Now they give you permission to be in business, yes or no. So it seems like a lot of these, really fundamental benefits that are supposedly there in the system are actually still at the will of the powers that be, giving you the permission to work with people like me. I could see a B2B, operation for this, right? So B of A can figure this out with JP Morgan and they can figure out how to do this stuff easily, but how do I do that without being the expert in the tech?
I could share a little bit. So from maybe from my perspective, we at Coinbase, we provide wallet, and we have 108 million users with our retail wallet app, right? Now, those 108 million users are using our centralized exchange, to buy and sell crypto in different ways, and then we build a lot of features in there. So they're trusting us in that, and so this is, so that doesn't solve your trustless system. But we also have built self-hosted wallet infrastructure, where this is open source technology, but we build it, we maintain it, we put it out there, right? And engineers can build on it and tweak it, and that's available to you as well. So you have an option. As I think the most important thing there is that you can choose to opt in decentralized and trusted systems. You can also choose to have a path towards using trustless systems. And I think the whole purpose of this is to make sure that we do have an option.
If I could add to that, there will always be a need for a centralized system, and there will be a decentralized system. It won't be one or the other. It will always be some hybrid of the two. And yes, you're a little bit overwhelmed by the technology. I am too. And I always have this conversation with my crypto friends, and I say, that the UX, UI, which is user experience, user interface, is not very good. And they keep telling me it's 100 times better than it was 4 years ago, which is true, but it's gone from unusable to bad. It needs to go to, excellent before regular people start to use it. And hopefully they will get there at some point, but they are making progress in it. And if you think back in the history of technology, in 2006, when the first iPhone came up and the first App Store came up and the first apps were put on the App Store, most of us, if we remember back to 2006, I don't understand this. I don't know if anybody's going to use this. But it got better over time, and we've learned how to use it. And I think that we will eventually. But you're right. If the industry said, this is it, we've hit the pinnacle of the ultimate technology today, it won't get adopted. It needs to continue to evolve to get better and better. And if you don't have the time or the inclination or the patience to learn it, that's fine. There will always be a Coinbase out there that can serve as your intermediary to this space.
Will, final word?
No, Steve cut me off.
Yeah. Please join me in thanking our panel.
Okay, for all the investors in the room, we're going to have the next panel on how to invest in everything they just talked about. And Michael is coming up, along with Ian, who I see. Ian Toner is the Chief Investment Officer from Verus. Jessup is Head of Digital Assets at Fidelity. And Bill Kennedy runs a very successful and large outsourced CIO business. He is not allowed to talk to anybody that I work for or anybody from the city. All right, thanks.
Steve, and welcome to my neighborhood. Literally, this is my neighborhood. So I live here in La Jolla. The University of California, San Diego is here in La Jolla. The Rady School of Management is a part of that university. And so I'm thrilled that you're back in La Jolla, and it's great to be here. Steve also is in this neighborhood, I might add. And we've got a great panel. If you look at the makeup of this panel, we have Bill Kennedy, CEO of RiskBridge Advisors. More importantly, GIC Board Chair. Ian Toner, Chief Investment Officer, Verus Investments. And we have Tom Jessup, President, Fidelity Digital Assets. And to me, as a longtime investor, now an individual investor, but many years at BlackRock and Barclays Global Investors before that in the asset management business, this to me is what it's all about. And you know, I ask myself, should Steve Sexauer, Chief Investment Officer of the San Diego County Employees Retirement Association, should he have exposure in this space? And as Governor Waller said earlier today, I was very surprised to hear that 15 public pension funds were invested in FTX. Well, I'm guessing they were dipping their toes into that space and not really having too much exposure, but it was still a surprise to me as a fiduciary. Are we ready for that yet? And I certainly have my own views on that, but we have wiser people on this panel than me, so we're going to go down, and you know, if you look at the title of this panel, the way it was specified, crypto as an investment, a new asset class, a speculative asset, I think that's really the heart of this. Is it an investable asset for fiduciaries, or is it really the realm of individual investors, maybe family offices, and a different end of this business? So why don't we start with Tom? Tom, what do you say? Is this a new asset class, speculative asset?
It is both. It is a new speculative asset class. So we, just a little bit of background, Fidelity has been active in the space since 2015. We're a pretty quiet organization, but we're quite innovative behind the covers, and we maintain active technology R&D efforts. Now looking at things like quantum computing and artificial intelligence, but in 2015 it was blockchain. And so we've had 8 years of experience running various nodes of the Bitcoin blockchain, the Ethereum blockchain. We mine Bitcoin. We do many things in this space. We launched a commercial business. We've got several hundred institutional clients who've been working with us for a couple of years, and we also launched retail crypto for our individual investor clients back in November. And I would say a couple of things. I think that it is a new speculative asset class, and why do I say that? Number one, I tend to look at the space as a liquid public venture market. We heard from the prior panel that this is fairly revolutionary technology. Some might argue it is the fourth wave of modern technology innovation. We had PCs, then the internet, then mobile, and it could be blockchain is the fourth. And so it tends for me to line up a little bit with venture, and perhaps that's why some of these pensions had exposure to FTX in the venture sleeves of their respective portfolios. But really, institutions are focused on the space because they see the innovation, and they want exposure to that innovation. And I would say that is primarily the lens through which we look at this. And again, maybe to draw a historical comparison, we had the same fraud, the same number of failed businesses during the dot-com days, but because these were all privately funded companies, they weren't really out there in the public. There was no news about these companies by and large, and certainly some of them, but not all of them. And there wasn't a publicly observable price for those companies. And so for our clients, the journey started with Bitcoin, right? The Bitcoin blockchain was born out of the financial crisis. And was really meant to, in some ways, be a political statement against the profligacy and mismanagement of the public fisc, I guess. I mean, choose your reference point. And that attracted a lot of people, given that Bitcoin is an aspirational store of value. It's got properties that make it scarce. It is infinitely divisible. It can be transmitted from peer-to-peer in a matter of minutes. I saw a stat the other day that said since the inception of the Bitcoin blockchain, about $100 trillion of value has moved, which is pretty incredible. And that was sort of the gateway. And then people start thinking about, okay, what else is going on in the space? I think I understand the technology. What else is it good for? What are some of the other applications? And as the prior panel discussed, you have these layer ones, which are big open source computing platforms. And in order to effectively use those platforms, you have to pay in the native token. And so if more people build applications on these open source platforms, it stands to reason that more of the underlying native currency will be required, which will drive the price and becomes an important, really an essential, to be perfectly candid, aspect of this new distributed economy. You can't really, in some use cases, you can divorce blockchain from the native tokens, primarily in more of an enterprise setting, permission blockchain. But when it comes to public blockchains, you can't separate the two, right? The native asset is an important incentive mechanism and means of payment for use of these open source networks. And that is why our clients are increasingly interested in the space.
All right, thank you. Let's ask Bill. New asset class, speculative asset, what's your view?
Yes, we think both. So as an outsourced CIO, we're working directly providing investment advisory, institutional advisory, and helping pension funds and endowments and foundations and insurance companies and family offices try to work through these particular issues. Anything that goes onto the RiskBridge platform, which ultimately makes its way into a client's portfolio, has to pass 3 litmus tests. Doesn't matter if it's a stock, a bond, a speculative asset. Number one, there has to be a fit into our risk budgeting approach to asset allocation. And I would say from the venture standpoint, the technology standpoint, I would agree. We think we can get comfortable with the underlying risk and how that folds into the portfolio. But when it comes to the cryptocurrency, not so much. And part of it is because of the, first, there's just not a large enough sample size in terms of data, historical pricing data that gets us comfortable to say that annualized standard deviation of 200% is true and good. Even if it was true and good, that blows up a risk allocation approach. And so it becomes very difficult for us to put that sort of speculative asset into a portfolio, because to keep the risk balanced, we have to sell equities that we might like, we might have to sell credit that we might like, we might have to hold 20% cash, which we like a little bit more now. Thank you. Thank you, Fed. So that's number one. Number two, we have to get comfortable with valuation. That's user case, supply-demand dynamics that can be monitored, and ultimately, it would be great if there was some cash flow coming from that asset that we could discount at some risk-free rate to come up with a fair valuation. Where we really get hung up, and this is, our punchline at RiskBridge is we can invest in cryptocurrency and crypto technology, but we don't. And the reason we don't is because we can't get comfortable with the fiduciary hurdle. How can we ensure on a prudent basis that this is in the best interest of our asset owners? And it really starts to fall down around custody, around cost, around transparency. By the way, I'm learning so much from this discussion this morning, and I think there's going to be a lot of conversation to be had later today, and I'm very excited to see how the custody chain and the custody transparency gets addressed in the coming quarters and years. But at this point, we're just uncomfortable that we could not meet our fiduciary responsibility to our clients based on the structure of the environment today.
All right, thank you. I want to second that I've learned a lot also this morning. These have been really useful sessions, and I have 3 of my students from the Master of Finance. I'm the director of the Master of Finance program. I have 3 of my students here. I wish they were all here to hear this, because this has been so instructive, so useful to hear. By the way, if you need a good intern or junior employee, we have some great students for you. So Ian, I'm curious, what do you tell your clients? What's your advice on this?
So I totally agree. Prudence has been cool and exciting precisely twice. The first, when the Beatles released the song Dear Prudence, and the second, when Susie and the Banshees covered it. The rest of the time, it is necessary, important, and as I sort of commonly joke to institutional investors and to kids in our shop and elsewhere, the minute you think you've got something exciting, interesting, and new, first of all, go have a lie down. Secondly, it's almost certainly not new, and people have probably lost money that way at least 5 times in the past. And thirdly, go and have a lie down. The reality is, as fiduciaries for large pools of institutional capital, we represent teachers and bus drivers and sanitation workers and university professors. People, in many cases, whose income is lower than probably 98% of the people in this room today. Our job is to make sure their benefits are paid, that they can attend college on the scholarships that the fiduciary money we sit in co-fiduciary with the boards are responsible for, that the union members in the pension funds that in the Taft-Hartley space we work on, their health care is provided, their benefits are provided. And so that's the start and end of that conversation for us. Very similarly, although I tend to do it slightly more emotively than the more technical way you described it, but it's the same conversation. The reality is not, is this interesting, or is this exciting, or is this fun, or is this world-changing, because it is all of those things. But how can I find the clearest, simplest, securest, most effective way to build a portfolio in the governance structure for the particular organization? Because some organizations have the governance to do more complex, more interesting things than others do, to ensure that that organization has a high probability of meeting the obligations for which they exist. And that is, there's no cool baseline in that, but it is the thing that begins and ends our day and fills every hour in the day. And so the conversation about crypto, and to be clear, I've been following crypto and been interested in this space since there were news stories about people buying pizza with Bitcoin, right? Never invested in it personally because I hold a green card, and I was never sure about the exact regulatory structure and the danger of accidental felonies, which meant that I wouldn't end up being able to see my wife's family ever again, was too high for my personal risk tolerance. But it's not that I'm personally skeptical that there's a whole bunch of interesting stuff here. But for most institutional investors, you can lend money to the US government at like 4%, guys. Your expected required rate of return is maybe 6, 7, 8. The public equity markets now are offering enough return and so on and so forth. So down the chain of simplicity versus sophistication, you can probably meet most institutional investment requirement needs before you say, oh, and by the way, I need 10% of my assets in Dogecoin.
All right, thank you. So how do we get more comfortable with this as for fiduciaries? Is regulation the answer? Because as was mentioned in the last panel, the regulation is now coming into this space. So it's been the Wild West. But I mean, just this week, earlier this week in the Southern District of New York, the Department of Justice got a conviction for insider trading. An employee of a big exchange who knew what they were going to list leaked the information to co-conspirators, and that fellow's been convicted. So insider trading, yeah, it applies here. At least it does this week. And even more recent, on Wednesday, Bloomberg said that Kraken was near an agreement with the SEC regarding their staking business. And so, you know, proof of stake coins like Ethereum, you can stake the coin and then people work on the blockchain off of it. And they did. They're shutting down their staking business. It was unregistered security is how it's treated. I think they were offering something like a 20% annual yield that was being paid to the customer twice a week, and that's gone. So unregistered security. So now that's come to this space. So if regulation keeps moving in this space, are you then thinking that's what we need? I'll be more comfortable. There's another thing that Bill mentioned I want to come to in a few minutes, but just on the regulatory side, is this what's been missing? And as we go into this space now, it's going to make you more comfortable. Bill?
The right regulation would make us more comfortable, but I really think there's a natural evolution that has to happen in this space. The losers need to lose, and the survivors need to survive. And I think we just need to allow a little time and space for that to occur on the technology, perhaps on the payment system, and even in the coin space or the currency space. But I'd like to see the private market work its way out by punishing those who deserve it and rewarding those who deserve the same.
Well, I guess somewhat you could say we've been seeing that in action, right? FTX is gone, Binance assets are going up, so there are winners and losers. People thought there'd be a run on Binance. It didn't occur. So, you know, we'll see. It seems like there is somewhat of a shakeout here. Ian, regulation, will that make you feel better about all this?
So regulation's important. I kind of think of this, is anyone here familiar with Hank Hill from King of the Hill, who sells propane and propane accessories? So propane accessories, all the infrastructure and the technology and the companies providing that sort of back end of space, that's popping up already in private equity portfolios in a variety of different places. And that's a well understood regulatory environment, and clarity of regulation on the things that they're doing and the risk tolerance for that component of institutional portfolios. That's kind of the natural first place where this will pop up. Also, propane, direct exposure to cryptocurrency assets directly, is popping up little bits and pieces inside the hedge fund environment. And again, that's an understood regulatory structure. And as regulation becomes clearer, that will find its way in because people sort of understand the wrapper it's contained within and the risk tolerance, and they're selecting hedge fund managers already that, secure in the knowledge that hedge fund managers generally are doing pretty funky stuff, period, and you know how high octane it is. But again, the more fully integrated as standard line items in institutional portfolio, better regulation is a necessary but not sufficient condition for that, because any of these things coming on the table are competing with office buildings. Well, let's not talk about office buildings right now because they've got their own problems, right? But industrial infrastructure and equities and lending money to the US government and other well understood things which are also well regulated. So great, it's better regulated, regulation is clear, we've got case law in place, so on and so forth. You still then need to compete for risk budget and for market share within the portfolio, and that's a separate question. That will take time too.
Yeah, just on the regulatory front, you know, we every year, as do other service providers, poll a large number of folks in the market, and consistently over the past 3 years that we've been doing the survey, unclear regulation, lack of regulation has been a major blocker for institutions to get into the space. I think that given what we've seen in the market over the past year, with some of the, call it the excess and the fraud being winnowed out of the market, it's going to bring a much more aggressive regulatory posture. You've seen that again with the Kraken news this week, and Chairman Gensler, I think, was on CNBC this morning talking about it. We also think in Congress we're going to start to see movement towards legislation that will provide, you know, better guardrails for the industry, which I think, you know, the industry needs, and we obviously fully support. I would say a couple other things. I think education, as you know, you've all learned from these panels, and I can certainly attest, having been in the market for many years, this is a very complicated space, and anyone who tells you that definitively they know everything going on or they're experts is lying, even the people doing it. So I think that the education aspect is incredibly important. And even if, based on what the prior panel said, we're going to see more traditional activity moving to blockchains, forget what you think about crypto as an investment. Your organizations are going to need to learn how to use this new technology the same way that, you know, 25 years ago you had to make the transition from a voice trader to trading on a screen. So you need to kind of jump in and start learning about it. And then I think the last thing we hear from our clients is, and it's very interesting, we ask the question, you know, what are the other blockers? And they'll say lack of fundamentals with which to gauge value, which is deeply ironic because these are public blockchains. Every last bit of information you need to make an investment decision is publicly available in golden record data, not manipulated, right? It's recorded on the blockchain. What I think people mean is, what is the canonical reference around valuation and how to think about these things? What is the gram and dot for crypto? And I think it's really difficult. Like, we're starting to think about this, and there are interesting startup companies that are doing things like calculating protocol revenue, so you can get to something that looks like a price to sales ratio for Uniswap, as an example. I think that's the other thing, again, for this to really move into the mainstream and kind of out of the pure venture sleeve. Those are probably the three things that need to happen. But regulation, clearly, to me, is a threshold issue.
All right, thank you. Yeah, so work in progress. And I think that was stated earlier that, you know, this is an evolutionary process. I see this as like growing pains for a new business, new industry that started out, you know, Wild West, and it's developing on a trajectory that will eventually, I think, have large asset owners very interested in the space, but it's certainly not there yet, I would argue. And Bill mentioned the issue of the risk budgeting. So I'm director of a research center at UCSD where we work with pension fund CIOs, and Steve is on our CIO advisory council. And so right now we were talking at our recent meeting about capital market assumptions. You know, so investors want capital market assumptions, long-term assumptions regarding expected return, expected risk, and for something like the crypto space, as Bill mentioned, the history is very small. You know, where do you usually come up with such things? People look at the history and then we'll tweak it somewhat and say, well, the world's not like that now, and it's changed somewhat. But have you seen anything like that, like capital market assumptions for the crypto space, Tom?
No, I mean, I think, you know, folks have tried to take Bitcoin as an example, right? It's not paying a yield or no cash flows, try to put it into more of a traditional asset allocation model. And I think it's very dependent upon the time frame of reference, right? Bitcoin for long stretches of time has been uncorrelated with other asset classes. For other periods of time, it's very, very highly correlated. And that approach to me, I think, will be challenging for Bitcoin. I think for some of these other assets, you look at proof of stake where there is theoretically a yield through participating in network validation, earning staking rewards, or even looking at these more fundamentally, I own a native token that powers some application. That application is generating revenue. Depending on how the governance works, I could have a claim on that revenue as a token holder. There will be ways to value these things, but I think the top-down asset allocation approach, I think, is still a work in progress from my perspective.
What about you, Ian? So you're a consultant. Capital market assumptions for crypto?
Very, very difficult. We try and be, it won't surprise anyone, incredibly boring when it comes to creating capital market assumptions, make it as robust as possible, use robust data, use best practices, and very similar to the way that everyone else does it. And almost none of those metrics in terms of, you know, robust understanding of income and robust understanding of value, they inherently don't exist because of the rate of change and because of the short history. That's going to make it. And by the way, that's not being critical about the crypto space. It's just saying let's recognize one of the biggest flaws in our industry is that people want to fill in the gaps of space we don't know about with certainty that's not real. This is one of those places that's super interesting. There's all kinds of opportunity in here, but it's just not forecastable in the way that public equity markets are forecastable. P.S. Public equity markets are quite hard to forecast, right? So it's way less robust than that, which isn't a criticism of this space. It just means it's a different deal, and let's not pretend it's the same thing yet, because eventually it might be, but not for years.
Well, Bill, you already said you don't believe in the historical standard deviation estimates you can generate from the limited data available. So have you seen anybody coming up with capital market assumptions for this space?
We've not, and the analysis we've done to get comfortable with our rejection of cryptocurrency, since the beginning of Bitcoin's trading, the Sharpe ratio on Bitcoin is by far the highest Sharpe ratio of any asset class since 2010. So in a traditional mean variance optimization, that's just a heat-seeking missile looking for the highest Sharpe ratio. That's where I want to put my capital. And so it goes to Bitcoin unconstrained. It would go to equities. It might go to equity long-short hedge funds after that. But when you look at the Sharpe ratio, it's 182% annualized return. But it's almost 200% annualized standard deviation of that return. Let's see that normalize over time, right? More data points, again, more time and space to allow some of the cryptocurrencies to come through. And Ian, I completely agree. We're using it now to protect our clients, but at some point we may see realistic returns and standard deviations that then start to fit into that risk budgeting process where it makes sense. But we've not seen anyone be bold enough to try to forecast the future of cryptocurrencies.
Yeah, given how competitive the consulting space is, I'm surprised no one has been offering capital market assumptions for this space. So, and maybe they have, but we're just not aware of it at this point. Tom mentioned that this is a public record. You can see everything. And part of the folklore of this market is that there are whales that will move the market and basically manipulate price, right? So they come in big, the minnows follow them, and then they sell out. And so you can look at the whales' wallets, and you can see the flows from those whales' wallets. And now regulation hasn't come in yet on manipulating the market, but if this trend continues, should whales be worried that they're coming after you? It's just a matter of time. Bill?
I don't know how to respond to that, just because I do think it will matter from the liquidity and the flow perspective, but I'm going to defer to my two partners for their insight.
My take on it would be, without talking about any whales individually or collectively, the reality is that this space has the benefits of transparency, and there are normal market practices that generally, there's the general law of doing business and behaving appropriately and so on and so forth. And it is likely that it is always a good idea, whether you think you're going to get found out or not, to adhere to the law and behave appropriately and responsibly in business, and if not, that's a bad thing.
I might maybe answer the question a bit differently, which is I think we've seen a real maturation of liquidity conditions in crypto markets generally. Obviously, you're seeing most of that with the higher market cap assets, Bitcoin and ETH, where we transact for our clients. We're very happy with the executions we're getting and where we source liquidity from. We've also done some empirical research looking at this very question. We were one of the applicants for a Bitcoin ETF in front of the SEC some time ago, and others have done this as well, that spot Bitcoin markets trail the CME futures in terms of price formation, right? So price setting in Bitcoin specifically appears to be led by a regulated futures market, which perhaps is a sign of maturation of the industry. If you had asked this question a couple of years ago, I might have said differently. I still think that in the lesser traded coins, lower market cap coins, whether due to the whale effect or just the centralization of the protocol, probably more of a risk of that type of market manipulation.
All right, thank you. Well, we should ask the audience for questions, and please raise your hand or stand and ask our panel a question, please.
Jim, I'm nervous.
I'll ask the question by making a quick statement in the front. In the last 15 years, if you look at the 11 sectors of the S&P 500, the worst performing sector has been the financial sector. Within the financial sector, the worst performers have been the money center banks, and the European and the Japanese banks have lost you money. Japanese banks going on 40 years now, and they're still losing your money. Is the market sending us a signal that the financial sector is ripe for disruption? And is this the disruption that the financial sector is looking at getting? And does that mean that it's incumbent on all of us? If you agree with that, is it incumbent on all of us that we make an effort to try and understand what's coming? Or do you disagree with that premise?
Jim, I would say we definitely should understand what's coming. The question I always come back to, we're coming through a 15-year period of really bizarre monetary policy globally. The party bus that brought us 20,000 cryptocurrencies and fracking and Airbnb and a number of other businesses that should not have ever existed, but they did because there was free money, that party bus has left the station. So what I ask, and what I am curious about, is in a more normalized monetary policy environment where the price of money is a bit more visible, what happens to this whole space? And is the historical underperformance of the financial sector a result of what we've seen from monetary policy and banks' abilities to survive? But I think we have to look at it in the context of the environment that we've been in from a monetary standpoint on a global scale.
Look, I work for a traditional financial institution, and I think that in some ways this will help our business. I do think on the disruption scale of things, the one thing I'm just left with is just the inherent operating leverage in disruptive business models. I mean, you think about the Bitcoin blockchain, it was an open source project. There are now hundreds of millions of wallets. There are 40 million Bitcoin wallets that hold a positive balance. There's a viral adoption mechanism. And I don't think you can underestimate just the embedded leverage there is in terms of disruptive founders and technologies, cloud computing and other things, and viral adoption of technology. And look at that and say, yeah, we'll be fine. It's one of the reasons why Fidelity is trying to stay on top of it. So, but I also think, part of our value prop is we think we want to try to disambiguate as much of this space for our customers as we can and deliver crypto solutions alongside everything else we do. We don't think it is this magical unicorn thing and people have their crypto experience and then they'll have their assets somewhere else. And so I think we could be a net beneficiary of it, as can other financial institutions, so long as they really stay on top of it.
So, first of all, absolutely people should be focusing on this area, thinking about this area, educating themselves in this area, because there's components of the technology that is going to be fundamental to the way, looking out 30, 50 years, that's going to be fundamental to the way the economy looks and acts, just like AI is going to be fundamental to, and so on and so forth. There's a whole range of disruptive technology, so absolutely people should be focused on that, understand what it means. Absolutely, I call it funded foolishness. The last 10 years, there's been a whole bunch of funded foolishness in the old economy and the new economy, and over the next few years, we're going to see what that was and how that looked like. So it's very difficult to draw linear things from now looking out 3-5 years, financial institutions, old line, new line, and so on and so forth. So that's maybe one step too far, but understanding what these tectonic shifts are going to look like, the ways it's going to be embedded into both traditional and new financial institutions and offerings. One of the fascinating things reading financial history is the degree of long-term change is absolutely gigantic over the course of time. And then when you look at sort of 3-5 year periods, there's very few of, there are some, but there's very few of those where you get instant change. The industry and the economy and the world changes much more in the long term and much less in the short term than people think. And often in these conversations, the focus is on the short term and, while exaggerated up or down short-term expectations, and less on those long-term things. So that's where we're focused, is the long-term implications.
Great discussion. Thank you all for that. So, Ian, you made the point earlier that, I think if I heard you correctly, that you're seeing crypto or digital asset exposure kind of percolate into portfolios and into manager strategies already. And I think, if this topic is a new asset class, as an isolated feature, is a little bit different than what I'm seeing from clients, which is that they're looking at digital asset hedge funds and digital asset venture funds inside of existing asset classes and saying, can I find a manager that's playing in this space that is going to produce alpha, or we expect them to produce alpha, and we're willing to take a bet on that. And Tom, you made this point too, in a traditional wrapper. So today there's 2,000 hedge funds, maybe 50 of them are maybe institutionally investable. There's been a really big reset in terms of the quality of custodian infrastructure behind them. And so there are options today where you can get very high quality back-end infrastructure with a only Bitcoin strategy, for example, and you can harvest volatility. So curious, if you think about getting a little bit granular in specific strategies on playing this trend, how do you advise clients that are interested in that?
Well, certainly from our standpoint, what I'm talking about at the moment is unlikely to be funds that are concentrated on the crypto space, but is more recognizing that there are hedge funds out there that trade across a whole range of different assets, and a small component of what they're doing, they're recognizing patterns and behaviors in crypto space that rhyme very similar with other asset classes. That's where I'm saying it's bubbling up into most institutional portfolios, rather than I'm going to allocate 5% of my hedge fund budget to a crypto-only vehicle. And the same in private markets. I don't see a line item saying crypto venture capital, but absolutely there are going to be venture capital vehicles that are focused on opportunities in the broad crypto space that will get funded, but that's not because they're meeting a crypto line item. It's because they're really smart people who've demonstrated they can add value by being ahead of the technology curve and who have an opportunity in this component of the technology curve, just like people in green technology and AI technology and all kinds of other areas of technological innovation will get funded too. So it's embedded in that sense, but it's not, I don't see a day in the foreseeable future where for large institutional investors there is a crypto line item. Not for quite some time.
We would concur with that. We're looking at fintech venture as that line item. And if there happens to be picks and shovels related to crypto there, that's perfect for us. And we can get comfortable with that on the fiduciary basis if we can see the custodial elements and the costs in the regulatory environment.
Hi, gentlemen. Thank you for being here today. This is definitely a fascinating conversation. I wanted to come back to the early part of the discussion here where you kind of had elaborated a little bit on thinking about these digital assets in the context of your fiduciary responsibilities. And also kind of reference what Governor Waller said this morning about no intrinsic value here. I mean, obviously, there's a lot of use cases people talk about with crypto and digital assets, but if we were to just kind of zero in on one of them that's been discussed since Bitcoin in particular was relatively young, it's sort of the digital gold concept. And gold is an asset, that doesn't have cash flows associated with it. It's sort of one of these things where if you set aside the industrial use argument, people kind of buy it because they believe that other people will want to have it at some point in the future. And you may or may not agree that it's a worthwhile investment or something to allocate parts of a portfolio to. But it doesn't feel like maybe you'd come under fire in a fiduciary sense if you were to make that part of your portfolio allocation. And so I'd just be very interested in hearing, if you think that similar logic could apply to something like a digital asset that would be a parallel to gold, or how you would think about that or discuss it with your clients. Thank you.
So one of the elements, and there's a variety of ways you can talk about different regulatory environments, what exactly the line-by-line details of the fiduciary standard are, but they coalesce around a single basic idea that prudent or reasonable or sensible people who do this kind of thing regularly would reasonably do this thing, right? So there's a little bit of that embedded in everything around the fiduciary standard. People have regarded gold as a store of value for 5,000 years, 6,000 years. People have regarded Bitcoin as a store of value for some order of thousands of years, fewer than that. And so I mean, it's possible there's a new dig at Luxor with blockchain, but I'm not aware of that. And so and that's one of the both frustrating and useful components of trying to look at things with as strong fiduciary oversight as you have to if you do what many of us do in that institutional space is that there is an inherent underlying component of the fiduciary obligation that takes an appropriately skeptical look at things that are new and interesting. And that's just part of the deal. You need to consider them carefully, you need to think about them hard, but new ideas and new things you really have to understand before they jump that hurdle. Most of our institutional clients will not be directly invested in gold either, by the way, but the case for institutional investment in precious metals as a store of value, as inflation protection, is one that is well understood and goes back for many thousands of years, and that's just not the case in crypto.
For a long time, commodities, precious metals in general, have been considered an asset class, and my observations on pension funds, especially public pension funds, is they will not be on the front lines. There's a lot of inertia and a lot of hesitancy, I think, for good reason, because of the damage that can be done if they make mistakes to their beneficiaries. So I think the largest asset owners will be slow to move into this space, maybe as part of a alternative sleeve of some sort in small amounts, but I think it's going to be a while and quite slow for adoption to occur with the largest asset owners.
Wow, sounds like power. I was thinking about the smart contract space in your discussion about the presence of regulation, thinking back to the subprime mortgage crisis, where there were a lot of private label securities that had securities contracts, which ended up being opaque, and some spent several years in litigation determining what claims could be enforced versus not enforced. Are smart contracts subject to that same risk? And if not, why not?
That's an interesting question. I guess the question is around the enforceability of a smart contract, a non-legal. I don't know. It's a great question. I don't know how to answer it. I think that, and this may be kind of a weak argument, by de facto, by agreeing to participate in a network that's governed by smart contracts, you are subjecting yourself to the execution of those smart contracts and the logic embedded in them. I'm not aware of, and maybe some of the other prior panelists might be aware of, there being any type of precedent around taking legal action because a smart contract didn't do what someone thought it should do, right? I think what's very interesting, and the prior panel spoke about this, even though all of the CFI lending over the past 9 to 12 months completely exploded and just completely deteriorated into nothing, all of the DeFi lending protocols performed exactly as advertised, without a hiccup. With smart contracts, you obviously have the risk that the contract has vulnerabilities in it and can be exploited. And so when you actually look at a risk factor is that the smart contract itself is not coded properly and the assets can be drained. But I'm not aware of the nexus of traditional legal arguments or approaches in smart contracts, but I'm sure some of the other panelists might be. Bankruptcy, yeah. Right.
Yeah, and just generalize that thought a second. The reality is there's lots of things that we all do as institutional investors that are really well understood, that have been through 10 cycles of bankruptcy and ups and downs and problems, and everyone involved understands, well, Bob paid the lawyer's fees to settle that problem 30 years ago, and Jim paid the lawyer's fees to settle that problem 20 years ago, and Mary had that huge lawsuit that lasted for 5 years, and that's now all clear, right? And so you can go because you know how those things have been settled. Most of that stuff just hasn't happened in this space, which doesn't mean over the next 10 years, what we'll see is we'll see those cases, and most people don't want to see their name at the bottom of a Supreme Court brief 20 years from now as a X versus Y case being referred to. So that's a risk hurdle in anything new, is that you don't want to be the test case that makes the rule, and you discover that the thing you thought you were doing was the bad idea.
Yeah, all those lawsuits are in place right now. Over the last 6 months, SPAC-related lawsuits have gone like that, and crypto-related lawsuits have gone like that. So it's in motion. So please join me in thanking our panel. Thank you very much.
So here's the plan. We have lunch out in the courtyard. And so we've got the next hour for lunch and visiting, and then we will come back in here at 1, and President Harker will do a presentation, then there'll be Q&A, and then we will go to how all of this helps the economy grow higher and longer. Thank you, everybody. Okay. Do we have anybody still out in the lobby?
I'll find out.
Because we can lock the door so they can't get in. So we're now doing the pivot to the real side of the economy. And Taylor, who was in the back, asked that question about just being an everyday person. Like, how do I use this? And what does it mean for me? And how would I trust anything? And so trust, the payment system, what's happening is at the heart of one of the things the Federal Reserve System does. So I'm going to turn the microphone over to Bill Kennedy, who's going to introduce President Harker. But I think when you come away from this, you'll understand where trust and competency comes from, and also in the cyberspace, looking at the future. So with that, Bill, the microphone's yours.
Thank you very much, Steve. So one of the distinct honors for the Global Interdependence Center is we have a great landlord, which happens to be the Federal Reserve Bank of Philadelphia. And it is a distinct honor to introduce President Patrick Harker from the Federal Reserve Bank of Philadelphia, who's going to address monetary policy, and then I'll come up, we'll do a moderated session and go to Q&A. So President Harker, over to you.
Thank you. Now, Bill, I have to say, we were your landlord. I found out you're a Chiefs fan, and so
sorry, Jill.
Just for the record, I am wearing the official Eagles tie. Yeah, go Eagles, go Birds. So, look, it's great to be here in La Jolla, and again, I didn't realize when I got this invitation from GIC that this event would have a connection to the Super Bowl. That connection, plus, we flew over Arizona, and I looked down, and that's the closest I will get to going to the Super Bowl this year. So, go Eagles. This is it's been a terrific program, and we've already had some great sessions. So thanks GIC for putting on yet another great event, and for having me here today. So I'd like to talk a bit today about the rapidly evolving payment landscape, and in particular, how the COVID-19 pandemic brought unique challenges to American families and accelerated changes that were already in motion. And after I deliver my prepared remarks, I'm looking forward to your comments and questions. I will be measuring the economic and financial implications of the pandemic the way economists do, with dollars and percentages and trends. But I do not, and we cannot forget that the pandemic has been, first and foremost, a humanitarian tragedy on a global scale. More than 6.5 million people perished from the virus, including more than 1 million of our fellow Americans. And those numbers would have been much worse if not for the many public health workers and other essential businesses who stepped in so that others could stay safe. So, consumer finance. Consumer finance is an important area for study at the Philadelphia Fed, where our CFI, as we call it, the Consumer Finance Institute, continues to pursue path-breaking research. Simply put, the way Americans spend, save, and invest has profound consequences for the financial industry, the broader economy, and of course, the American families. So understanding consumer finance patterns and how they change and how they will continue to evolve is vital to the Federal Reserve's mission of fostering an economy where all can thrive. And speaking of the Federal Reserve, and here I have to give my standard Fed disclaimer, the views I express today are my own. I may agree somewhat with Governor Waller, may not, we'll see. But they do not necessarily reflect those of anyone else on the Federal Open Market Committee or in the Federal Reserve System. So I think we all know that the COVID-19 pandemic changed a lot about American society. Some changes, such as our inability to convene in events just like this, were thankfully fleeting. But in many areas, the pandemic simply accelerated changes that were already taking place, and it is quite natural to think that those changes are more likely to remain. So, to disentangle the fleeting from the long-lasting, we need to look at how consumer finance was already changing prior to the pandemic, and how the American people and the institutions that serve them reacted to the unprecedented circumstances of the pandemic. So today, I'll share some of what we've seen in the realm of liquidity, spending, and adoption of new financial tools over the past few years. So I'd like to begin by considering the effect of the pandemic on Americans' access to liquidity, primarily in the form of cash holdings and checking account balances. A staggering 20 million workers lost their job in April 2020. And while many were rapidly rehired, total employment only returned to pre-pandemic levels 2 years later. So data collected in November 2020 in our CFI, the CFI's COVID-19 survey of consumers, indicated that more than half of the respondents had experienced some type of disruption to their employment or income since the beginning of the pandemic. And as we know, one of the principal federal responses to the crisis was to provide direct stimulus payments through the CARES Act and enhanced unemployment benefits to Americans. So, how did these relief measures pass through to consumers' wallets? The pandemic certainly made life unpredictable. We can all attest to that. The Diary of Consumer Payment Choice found that consumers continued to demand cash in that uncertain environment. The Federal Reserve survey showed that on average, consumers held 25% more cash in their wallets in 2020 than they did in 2019. Now that figure dropped to in 2021 to be more in line with pre-pandemic levels, but we saw the surge of cash holdings. Similarly, consumers held more cash at home, in the car, or elsewhere in both 2020 and 2021 than they did in 2019 by significant amounts. So cash was important through this process. Turning to checking account balances, the Fed survey of consumer finances showed a generally rising trend in checking and similar balances through 2019. But unfortunately, the timing of the triennial survey did not align well with the crisis. So I would instead turn to some of the most timely information available on balances in consumer checking accounts during the pandemic, and this is published by the JPMorgan Chase Institute. The underlying data are based on a representative sample of their checking account customers. Now, keeping in mind that those customers may not entirely be representative of checking or deposit account holders in general, but I think it still provides some illuminating information. So according to the JPMorgan Chase Institute, the median balance in checking accounts increased significantly from late 2019, spiking at various times, matching the largest disbursement of stimulus funds, enhanced unemployment support, and tax relief. The money kept coming into their accounts. While this phenomenon occurred broadly across the study population, some of the largest increases were seen in the more vulnerable groups among us. Despite this seemingly positive news, it's important to keep in mind that many of these changes were the result of temporary relief measures implemented by the government. It is unlikely that permanent changes take hold in the overall liquidity of households, particularly in lower income households. In June 2022, median checking account balances remained significantly higher than they were in 2019, but they were also significantly lower than their peak values realized in March 2021. And while many low-income consumers had some of the largest increases, a sizable share have average balances lower in mid-2022 than prior to the pandemic. So as we move further into the post-pandemic economy, I think it's going to be crucial to understand which phenomena are likely to revert to the previous norms and which are sustainable and for whom. So we also saw quite profound changes in the way Americans made payments through the pandemic. These shifts speak to the adaptability of the American people and the financial system during unprecedented circumstances. However, it is also true that many of these changes were already in motion prior to the pandemic. Let me now take a couple of minutes to describe what we were seeing before the pandemic. Up until the end of 2019, there was a gradual decline in the share of consumer transactions that used cash for payments, and a much more rapid decline in the number and value of paper checks used to make payments. ACH transactions, typically direct deposits and some bill payments, were growing, but no longer as quickly as they had been in previous decades. Unmistakable was the rapid growth in the number and value of credit and debit card payments. Among those, consumer purchases online, typically made by credit and debit cards, outpaced card transactions used for in-store purchases. Finally, contactless card payments, digital wallets, and peer-to-peer payments facilitated by companies like Zelle and Venmo were still relatively uncommon, but they were clearly growing. Then COVID-19 hit. And like so much else, the way Americans spent changed dramatically. The Federal Reserve Payment Study did a comprehensive job of describing the shifts in non-cash payments that occurred in the first year of the pandemic. For one, the number of card payments, credit, debit, prepaid, declined in 2020. That was actually unprecedented. The total dollar value of card payments grew slightly, but that growth was well below trend. Industry sources confirm that the weakness was primarily in credit cards. In fact, the value of debit transactions increased substantially in 2020 relative to 2019. This shift from credit to debit cards began to reverse in late 2021, with the value of credit transactions growing more rapidly than debit. Now, so unpacking these top-level shifts, a mix of in-person and remote payments also changed early in the pandemic. In 2018, the total value of in-person and remote payments were about the same. But in 2020, the value of remote payments exceeded that of in-person card payments by about 10 percentage points. Now, this may be a persistent change because while consumers have resumed going to restaurants and grocery stores, they appear to be still making relatively fewer in-person payments in those locations, possibly because they can pay remotely and then pick up their goods. The pandemic also appears to have contributed to significant growth in several recent payment innovations. The growth in the use of contactless cards, for instance, accelerated even while the number of in-person payments declined. Contactless payments now account for 4.6% of the number of in-person payments, more than double its share in 2019. Now, there was a similar effect for P2P payments and digital wallets. In the first half of 2020, 18% of deposit accounts experienced their first P2P payment, and 11% of credit or debit card accounts experienced their first digital wallet payment. And I don't see those trends changing either. So we talked about cash as a means of storing liquidity, but what about cash as a means of payment? To examine those trends, we look again to the Diary of Consumer Payment Choice. The latest summaries of this survey report that the share of payment transactions made with cash has been falling over time, fell precipitously in 2020, then actually rose again in 2021 as in-person transactions picked up. So it's a bit of a roller coaster ride for cash. But the bottom line is that the cash share of payments remains well below pre-pandemic levels, this being a clear example of the pandemic accelerating the change that was already in motion. Finally, as is often the case, we can learn the most by going directly to the source, and in this case, directly to consumers. Late last year, the Philly Fed's CFI did just that, asking consumers whether they were using specific forms of payment more or less than they were in 2021. On net, consumers reported using cash and checks less and contactless cards more. They also indicated they were using more P2P apps and mobile payment apps more frequently. As is typically the case, younger consumers tend to be the most likely adopters of payment innovation. Roughly speaking, this suggests that indeed, the pandemic accelerated the longer run trends of declining use of paper forms of payment and a more robust adoption of new electronic ways of making payment. And now for something that can't get lost between the seat cushion, the latest newcomer to the landscape, cryptocurrencies. As you know, and we've talked about, cryptocurrencies are digital or virtual currencies in which transactions are verified and records are maintained by a decentralized distributed ledger system using cryptography rather than by a centralized authority. We talked about that this morning. Since the early 2010s, the rise of so-called cryptocurrencies has received significant attention from financial market participants, policymakers, and academics. Cryptocurrencies have been marketed in a variety of ways, including at the last Super Bowl, by the way. Early in their existence, they were touted as a more secure and anonymous method of payment and a means of keeping funds out of traditional banking systems, while recent messaging has shifted to their value as an investment vehicle. Cryptocurrency markets have gained a reputation for obviously high volatility in recent years, with rapid price increases and decreases over relatively short periods. For a considerable stretch of time, beginning in 2019, prices trended up significantly, leading to a perception of cryptocurrencies as lucrative investment vehicles. Beginning in early 2022, however, the cryptocurrency experienced what is described as the crypto winter, a prolonged bear market that resulted in a nearly $2 trillion loss in market value, coin and exchange collapses, and a damage to a number of financial service firms that are closely aligned to the crypto space. So what did we do? So in January 2022, CFI, in conjunction with economists from the Federal Reserve Board, included questions related to cryptocurrency ownership and opinions in our CFI COVID-19 survey of consumers. The survey gave us a basic understanding of the adoption of an attitude toward cryptocurrencies among the survey population, with special attention paid to differences across demographic groups. The result of that survey are found in a CFI research brief published in December and available on the Philadelphia Fed's website. In the months since that survey was conducted, the drastic change in prices and associated turmoil, again, the recent period referred to as a crypto winter, likely contributed to shifts in attitude regarding cryptocurrencies among owners and non-owners alike. Therefore, in this past October 2022, we again surveyed consumers to see how perceptions of cryptocurrencies had changed. So I'd like to share some of the highlights from our published report and actually touch on some new previously unpublished information based on this most recent survey. In the survey fielded last January, we found that almost 1/4 of respondents or someone in their immediate family owned cryptocurrency at that time. Most current crypto owners had acquired those assets recently. More than 2/3 of crypto owners last January had acquired their first crypto asset within the previous 12 months, almost 1/3 in the previous 6 months. This surge in adoption took place in a media environment that saw massive increases in the marketing of cryptocurrencies during 2021. Unlike many of the other changes discussed, the rise of cryptocurrency does not seem to be directly related to the pandemic, though an environment of low rates, ample liquidity, and quite frankly, more time at home may have contributed to this. The survey asked owners about why they chose to purchase crypto. Just under 30% of crypto owners cited financial reasons, though some viewed their purchases as short-term investments in anticipation of rapid appreciation, while others were actually looking for long-term investments for stable growth. Almost 1/4 of crypto owners had acquired their assets out of simple curiosity, and just under 20% suggested their decision was influenced either by family or social media. A relatively small share of crypto owners, around 15%, suggested they had acquired their assets primarily because they expected to use them for transactional purposes. We also asked about future crypto purchase plans. Last January, slightly more than half of the existing crypto owners, 55% in fact, said they were likely to buy more crypto. Non-owners remained skeptical, with less than 7% of them saying they were likely to buy crypto in the future. Now, this is interesting. Demographic analysis of crypto ownership, for the most part, conformed to our usual expectations. For example, crypto ownership is relatively more common, as you would expect, among younger respondents and respondents with higher incomes. That's consistent. It's consistent with research suggesting these are the categories of consumers who are more likely to be early adopters of new financial tools and any new technology. Similarly, the likelihood of owning crypto assets was higher among respondents who are also engaged in mobile and P2P payments or mobile banking. Men were more likely than women to own crypto assets, and Black and Hispanic respondents were more likely to own crypto assets than white respondents, and I think that's interesting. Now let's turn to what we learned when we examined responses from consumers this past October. Keeping in mind that respondents to the January survey had yet to go through the crypto winter, while October respondents had already lived through most of it. And it shows. Crypto ownership among respondents decreased significantly from 25% in January to 19% in October. We observed decreases in the rate of ownership across all demographic groups. Nevertheless, the relative concentration of crypto ownership across the population changed little. Younger, male, more affluent, or non-white consumers remain the most engaged demographic groups with crypto. Future plans to purchase more crypto assets cooled, with less than 40% of October's owners indicating they would likely buy more crypto in the future. Remember that in January, more than half the respondents said they had future plans to buy more crypto. Despite the crypto winter, short and long-term investment remains the most commonly chosen set of reasons for buying crypto. Indeed, these reasons seem to have become even more important. In October, 35% of crypto owners cited long-term growth as a principal reason for owning. That is an increase from 29% of crypto owners last January. Somewhat less surprising, crypto owners in October were less likely to cite social reasons for holding these assets than were crypto owners in January. Interestingly, curiosity remains strong as a purchase reason. It's actually increasing from 24% of crypto owners in January to 30% of crypto owners in October. We see this as an indicator that there is still interest among consumers in cryptocurrencies, with the depressed prices of crypto winter possibly providing an opportunity to satisfy that interest for some. So what do we take from all this data? In many ways, it is what we would expect to see from a market after a downturn. Participation and interest in the market both decreased as groups of consumers shied away from the risk. The strength of investment and experimentation as reasons for participation in the market did remain steady, and the socioeconomic groups most likely to acquire cryptocurrencies haven't materially changed. These patterns seem to suggest that cryptocurrencies will remain in demand by certain consumers despite the recent crypto winter. So I realize I've thrown a lot of data and facts at you, and although we are convening here in a college town, there won't be a quiz, I promise. As an old professor, I won't give you one. But I am going to assign some homework. Have a look at the consumer finance section on the Philly Fed website, and you'll find all this work there and more. What I do think is that these data offer a unique insight about the way American society responded to the COVID-19 pandemic and its unprecedented strain. It allows us to discern which changes are likely to be fleeting and which ones are already in motion prior to the pandemic and are likely to be long-lasting. We saw how the pandemic-era policies and lifestyle shifts led to a run-up in household liquidity. However, overall, this run-up is not likely to be sustained for everyone. We saw Americans embrace new ways of making payments as they first shifted to online shopping and then made changes to their payment habits that apparently have real staying power. And we've seen how consumers responded to dramatic changes in the cryptocurrency markets, slowing but not likely reversing the growth of that sector in coming years. What we have yet to see is how these shifts will play out in the long run and how they will affect the Federal Reserve's solemn responsibility of fostering an economy where all Americans can thrive. So again, thanks for having me. And remember, it's spelled E-A-G-L-E-S, Eagles.
Well, just to show GIC's commitment to hosting a neutral forum, you have an Eagles fan and a Chiefs fan on the same stage. I'd like to start the Q&A with a very important question we were discussing at lunch. And President Harker, do you agree that Andy Reid is a great coach?
I do, actually.
So
I agree.
We
Because he was an
common
Eagles
ground.
coach at one point, so.
We found common ground. Thank you. Thank you for your remarks, and thanks for spending the time with us. Maybe to kick off, could you just share with us, you referenced the research by the CFI. What were the origins of the CFI? How did that come about?
So CFI's origins go back to when Tony Santamera was president of Philly Fed. My old colleague from Wharton, he came over and brought a team with him. He stole them from Wharton, but that's okay. And they built what was called at the time the Payment Card Center. Why the Payment Card Center? Because of Delaware's footprint in credit cards. And so we built an expertise in the beginning around everything related to credit cards, then expanded out to more payments. And today, then when I got to the Fed, I looked around and I said, you know, we've got these tremendous assets all across the bank because in our supervision, regulation, and credit department, we build and maintain the stress test models on the consumer portfolios for all the major banks in the country. And so we have deep expertise around everything consumer, auto lending, mortgages, et cetera. And we started to build a lot of expertise, and we have a lot on our website, by the way. We can talk about this if you're interested, around student lending. And that's led into a whole research area for us as well. But we counted up the number of researchers that were doing work somehow related to consumer. It ended up being around 50 researchers. And so we combined that. We morphed the Payments Card Center into this broader issue of combining more people across the bank and collaborating together. And I think it's really paid off. It's been a tremendous asset for, I think, the bank and the whole system.
And into that research around the consumer, do you have an assessment, first quarter of 2023, how stretched is the consumer in terms of using credit and credit card debt?
Varies by income level, for sure. I mean, low-income consumers are increasingly stressed. You see this, they burn through their liquidity. I'm oversimplifying things, but they burn through their liquidity. Higher income, they still have a lot of liquidity. You talk to bankers, they're still seeing large balances, so that is not burned off in the same way. Because they didn't lose their jobs, right, during the pandemic either, generally. But the lower income people, they're the ones that took it the hardest. So, and as a result, we're starting to see credit card balances rise, particularly among the lower income community, the subprime kind of community. And so that's something I'm worried about, because it is starting to bite for those families.
So the panel I was on before, we had the discussion about growth of risky assets, of which cryptocurrencies we would put in that bucket. Do you think Fed liquidity and Fed policy over the last 5 to 10 years has influenced the growth of cryptocurrency and crypto assets and in this space? How do you view that?
Yeah, that's an interesting question. Look, I mean, I think keeping rates low we were in a period of extremely low rates, so it did give all kinds of people opportunity to invest in all sorts of things, because the hurdle rate was met even if it was pretty low, right? The company would look at their investment hurdle rate and say, well, I can get pretty cheap cash, capital to invest. So I think it wasn't just in the crypto space, it was all across the economy that fostered that kind of investment. We're starting to see some unwinding of that right now. We're starting to see some of the large tech firms backing off because they expanded tremendously during those periods, but now they realize they probably overexpanded. And as rates go up, they're pulling back the reins some. Now, we want them to pull back the reins some. We just don't want them to pull back completely, right? So we want the economy to keep growing, but we need to slow down to get inflation under control, and that's job one for us right now. And so, yeah, I mean, it clearly has an impact. This data, though, surprised me in some ways, in that a lot of it's experimentation, as I said. I mean, people just trying to understand, and I'll use, one data point's bad, but I'll use my younger son. Why not? He's not here. So, he's crypto curious. He started to make some investments, lost a lot of money. He's still a little crypto curious, right? And I think that raises a kind of broader issue among the American society. I'll get on my soapbox for 1 second. I think there are lots of good reasons, as you see here. I mean, people, and this is a pretty broad survey we've done. There are a lot of reasons people want to hold crypto, right? I don't understand them all. It's not me, I have to say, but clearly people are interested and people want to hold it. And some people think it's a long-term investment. Personally, I don't in my portfolio, but they do. So I have to accept that. That's what they want. And we have to let the market work its way out, as Governor Waller said earlier, to meet that need, because it's clearly there. I do worry a little bit about us, though, as an American society. This is my soapbox aside, away from crypto. We've become a gambling society. And I worry some about that, because not only did my youngest, he's on FanDuel and he's betting on games. It becomes so easy to do it's frictionless now to gamble. And I just think we're creating a situation which can be potentially dangerous down the road. That we have this gambling culture that has been facilitated by the ease of doing it. And I'm not necessarily putting crypto in that category, but for some people it is. It's just a speculative investment. They want to see what it is. And I just hope people aren't overdoing it, you know, for their own sake.
And just for the record, you and I don't have a bet on Sunday's game.
No.
Together. Okay.
Although I do have a bet with the interim president of Kansas City. And so if by some way we lose the game, I can't imagine how, I have to personally go into my cafeteria and serve barbecue. And of course, when we win, he has to serve Philly cheesesteaks in their cafeteria. So.
I'd say they're both winners, right? The staff's going to be both winners
no
either
loser
way.
in that.
Yeah, that's a good trade-off. You talked about the experimentation in crypto by the consumer. What about the business environment in your district? As you're out talking to various businesses, are you seeing any experimentation and adoption of crypto as a form of payment for their businesses?
Not really. No, I mean, not really. A little bit on the margin here and there, but I don't see any significant uptake in at least the businesses in our district. Of course, you know, there is another business which is illegal called theft that has adopted this. I have to tell you one story. So we had a bank that had a ransomware attack, and they called us, and we had them call the FBI and the U.S. attorney, and we have a protocol for how to deal with this. And they said, well, I think we just have to pay. We got to get. It's a small bank. We just got to get online. It's killing us, right? So they called back and they said they want it in Bitcoin, and we don't know how to do Bitcoin. I said, we can't help you there, right? It's not something we do. They called back and said, oh, we got it covered. The bad guys had an 800 number to call. Now think about this. The bad guys had a customer service line to call. Right? I mean, I don't know about you. I don't know about you. That's when I figured I've entered a very different world when the bad guys have a customer service number.
So I'd like to turn a little bit to economic conditions. You were talking about inflation and the Fed's commitment to bringing inflation under control. The question is, can we see wages slow, given that the unemployment rate is so low, at a multi-decade low?
Yeah.
How do you view that?
So we are starting to see glimmers, and I emphasize glimmers. At least in our district, we're starting to see a little bit of flattening out of some wages. That's already happening in manufacturing. We're already starting to see, as manufacturing cools, those wage increases have clearly, or at least in our district, when we look at our manufacturing business outlook survey, which is a bit of a bellwether that the street follows, we are starting to see it cool off because they're able to hold on to their people. I mean, the areas, obviously, that are hot are leisure and hospitality. Generally, healthcare continues to be hot. We're seeing the price increases in leisure and hospitality for sure, and that's going through. Healthcare is a complicated story because you only renegotiate your price every so often with your insurers and with the government. So that's going to take time to filter through. That's why we think inflation, while we want to get to 2%, it's going to take some time because shelter's got to work through these healthcare increases. We're going to see them. They're going to start to filter through. They have to because they have to renegotiate. I mean, nursing salaries and everything have gone through the roof, and the insurers are saying, no, we're not paying until we get to a new negotiating period. So that's all going to have to filter through the economy over a period of time. Is there going to be inflation pressures from wages? Some. But remember, there's two variables here that companies have. Not forget the hospitals for a minute, which is, and healthcare generally. But you got margins and what you're going to pay and your price. And I think we're starting to see, again, I can say in the manufacturing area, we're starting to see some margin compression happening because people are realizing their customers are now pushing back on them. This is what we hear time after time, contact after contact. Yeah, no, that surcharge you kept putting on, I don't buy it anymore. So take it off, because I got another supplier. And so we're starting to hear as supply chains normalize or go to a new normal, they are going to change. We're starting to see some margin compression, so the prices aren't going up as rapidly. So, and I think that's going to continue for a while.
Terrific. Let's take a couple of questions from the audience. I'm sure we have a few. Steve and Jill, we have microphones?
We have microphones.
There's a question right over here.
Jill is right behind you with a mic.
Hello.
President Harker, you mentioned early on in your comments that some of the things from the pandemic are now accepted. And specifically, I'm going to focus on the contactless payment, payment by debit card, credit card, et cetera, et cetera. What I'm noticing is a lot of businesses prefer that. In fact, they actually want it versus cash.
Yeah.
And specifically, I've noticed in the restaurant industry, they want to charge you what I refer to as an inconvenience fee for using your debit card.
Yeah.
Well, I view that payment to, I'm going to use Visa as the example, the payment that merchant needs to pay to a Visa, I view that as a cost of doing business. My question to you is there anything coming up in the near future that can prevent these businesses from charging what I view as an inconvenience fee, and they're gouging the consumers?
Yeah, I mean, I think the only thing that would control that is market competition, right? People just not go to that restaurant. Otherwise, I don't see how regulators could step in and tell the mom and pop restaurant they can't charge you what they're going to charge you, as long as they're upfront about it, right? As long as you know upfront you're going to have to pay this. It's up to you to decide whether to pay or not. No, so that's where I don't see that changing a lot. There is an interesting backlash on this that, like though I can give you the example of Philadelphia, and there are other cities in the country that have done this too, to force by law, local law, the merchants to accept cash. Because during the pandemic, they all wanted to get out of cash, right? For lots of reasons. And they still want to get out of cash for different reasons. It's not so much the pandemic, but given some of the increase in crime in cities and other issues, they're like, we'd rather not take cash. Well, who pays with cash? It is not predominantly, but it is more highly likely that if you're lower income, you're paying with cash, right? And so in a city like Philadelphia, they got so many complaints from the residents saying, I can't go in the store and buy anything because they won't take my money, that they passed an ordinance that forces merchants to take cash no matter what. So that's also happening on the other side. It's not just that the merchants are charging potentially the fees you're talking about, but they also really don't want to, in some cases, deal with the cash, but they have to in certain cities by law.
Jim.
You're, President Harker, you are in a big, large urban city in Philadelphia, and post-COVID, we've seen a lot of remote work. What are people telling you about the state of the real estate market and the state of remote work?
Good question. I mean, we spent a lot of time thinking about this, and it's a complicated story. And so right now, the short term is people are nervous, right? If you're a commercial real estate holder right now and you have a big office footprint, you're nervous about this because you just don't know where this is all going to end, what the hybrid workplace is going to look like. So I'm going to paraphrase an old colleague of mine from my old days at Wharton, a guy named 𝗵𝗁𝗏. Peter has a little book out in Wharton Press. It's interesting to read. So Peter is an HR guy. He's a human resource management scholar. And he goes all the way back to the 1970s. Why the 1970s? In the 1970s, when the smog was just crazy in LA, LA imposed even odd license plate going into the city. And they coined the phrase telecommuting. Now, that phrase, we still call it telecommuting, even though we don't we commute, but we Zoom commute, maybe. And so what Peter's point is, we have 50 years of history of understanding remote work in various ways, shapes, and sizes. So this is not a completely new phenomenon. Again, accelerated through the pandemic, but we've been down this road before in different ways. So what do we know about that? We know a couple of things about that from all that years of scholarship, that eventually people will want to come back to the office in various forms. Not right now, because there are barriers to this. And who is most likely not to want to come back to the office if you do the survey work? It's women or men with staying home with children. But predominantly women have taken on that burden. The reason Peter brings this up is we've been down this road before. These are situations where class action suits are likely to occur. Because out of sight, out of mind. Who gets promoted? Right? It's the person you've seen around, working hard, staying late, in the office. They're the ones that get promoted. The ones who you never see, unless you can have great metrics for measuring their work, they get to be overlooked. We know this, right, through history. So he's saying you got to be careful about this, that you're making sure that an equal number of, in terms of gender and race and so forth, are taking advantage of remote versus office work, because if not, you're raising some issues. And that got everybody's attention. There was a room of CEOs, and they're like, oh, I didn't think about that. And so there are lots of issues that we'll see how this plays out over time. That said, in the short run, yeah, the commercial real estate is a significant issue. I mean, companies, our big employer in the city is Comcast. They forced their employees back 3 days a week. And early on, it was forced. But part of the problem is, if you went in and you were the only one there, what was the use? So they're trying to force people, like many of your companies, to be in certain days of the week so that you interact. It's upon management to make sure that that's useful. The other thing that's happening, I can say just in the Philly market, is life sciences are booming in Philadelphia because of the University of Pennsylvania invented mRNA technology that underlies all our vaccines, and the cell and gene therapy for cancer. So every biotech pharma company around the world wants to be in Philadelphia and have wet lab space. So for the space that you can convert, they're converting office space to wet lab space. You can't do that everywhere, but so I think there's also, you're seeing those kind of facilities getting repurposed into something else. And in this case, in Philly, it's wet lab space. Other places, it's apartment living. So we'll see how this turns out. The jury is really still out on all this. I mean, we're right in the middle of it. It's hard to see where this is all going to end.
Horacio, please.
Hi, quick question on the unemployment rate, which you mentioned being all-time lows. But we have a couple million people that haven't gone back into the workforce since the pandemic. Is there anything in your mind that encourages those people to go back? Less benefits from the government, things like that, that can sort of solve this issue with unemployment?
Yeah, I mean, the early evidence is that just less benefits alone aren't going to do it. Because I'll use an example. So we, through our community development function, we've been conducting research and convening in the state of Delaware with the Chamber of Commerce in the state and the state itself. And the philanthropy is funding some of the work around trying to come up with creative solutions for childcare. So Delaware is not, it's not San Francisco, it's not here. It's not that high a cost of living state. Per kid, per year, childcare in Delaware is $20,000. If you have 2 kids and you're making $50,000, it ain't worth it, right? It's just not worth it. So we've got issues around childcare. We've got issues around transportation. I mean, what we know is it's a more complex issue than just remove. Take cities like, the Bay Area or New York. I mean, if they need workers, but people can't find any place to live, even remotely close, that's affordable. And the commuting options are horrible. So they don't work. they find some other place to work. They're not going to go in the city and do this. So it's a combination, and we have a whole initiative at the Philly Fed, which we call the Economic Growth and Mobility Project, looking at what are these barriers to employment that are beyond just the economic incentives. And it's things like healthcare, childcare, transportation, housing. You can go down the list of all these things that they all add up in somebody's mind saying, yeah, it ain't worth it, man. It's just not worth it for me to take that job for $15 an hour because I'll actually lose money taking the job. And so I think some employers, Delaware's a good example, it's a small state, are banded together saying, we got to solve this problem. We're going to have to figure out a public-private model to do this. We can't do, and some of that may be tax incentives for employers, right, to get some tax breaks to subsidize childcare. I don't know what the answer ultimately is, but we need some creative thinking around this because to just think that we turn off the tap and people are going to go back to work. That said, I'll hop on my second soapbox. I am not, and I'm going to triple down on my disclaimer. I am just the Fed. We do monetary policy. But we also look at square in the eye of the economy, and we need more people, right? So there's two ways to get more people. Get people off the sidelines, get them the skills they need to get to work. That's a big part of the workforce development effort we really have across the Fed in trying to figure out ways that we can get more people to work. And not us, we don't do it, but the research on this. And the second piece of this is we need an immigration policy. We're millions of, at least 2 million shy. Now we're catching up a little bit, but we got a lot to catch up on. And so this is not one thing. I mean, what I get frustrated by is when we talk about policy, we think that there's an answer, one thing to do that will solve all things. It won't. It's like playing whack-a-mole, right? We try to hit this one, and then this one pops up. We really need a systemic approach to say we need to move all these things all at once. We're not going to make a difference.
Question in the back.
Yeah, hi, first of all, I'm a Cowboys fan, so
all this Eagles we both
talk
don't
is
like
tough.
Okay, thank you, everyone.
Yeah, and we're done. I didn't realize we were going to get to ask questions beyond crypto world, so this is great. One of the questions I continue to get asked recently by clients is just opinions on what happens around the debt ceiling and if there's, additional brinksmanship and, what happens, right? Obviously, a topic du jour. But I would love to be able to tell my clients, well, I was talking to a FOMC member the other day, and here's what he said. So go for it.
Why not? Okay, quadruple down on my disclaimer. That's in the hands of Congress, not us. But the consequences would be incredibly dire in my mind. We'd get through the short-term consequences of that, but the long-term consequences for the United States would be severe. Go back to the morning. All the conversation in the session this morning, one word kept popping up: trust, trust, trust. Our entire economic system runs on trust, all of it. That, at the end of the day, is what makes the wheels turn. Once you lose trust, it's really hard to get it back. In business, if you've blown trust with your customer, it's really hard to get back. Imagine us as a nation, the leading nation in the world, defaulting on our debt. That's hard to recover from. And our competitors, enemies, will cheer in the streets if we did that. This, in my mind, is one of the most damaging things we could do to this country. It's just and look, I'm a bit of a deficit hawk, but this ain't the way to solve the problem, in my mind. We've got issues in the federal budget, but this isn't it. This is not the way to solve the problem, and it would cause real damage to the American society. So,
President Harker, we had a conversation in December in Philadelphia at an event, and I asked you the question, this gets to your trust point, about the independence of the Federal Reserve. Can you just speak to the importance of Fed independence, and what's the conversation around the table to that topic as you're meeting with your peers and colleagues?
Yeah, we've gone way off the crypto train. It's good. It's good. Yeah, I mean, that is absolutely central to the mission of the Fed, or really any central bank. Once you lose that independence, you've lost the trust. And once you've lost the trust that this institution, look, we're not perfect. No institution's perfect. But I think the Fed is a remarkable American institution. It's remarkable in terms of our structure. We're the only central bank that's decentralized and centralized at the same time. And I think that structure's served us well over the years. It provides a unique perspective in each one of our 12 districts that we bring to the table. But that independence, and we got to be careful about that, right? That we don't cross certain lines. That's why I'm careful in all these comments. This is not my business, other than to say it's an issue. It's an economic issue. I can't solve it. That's for other parts of government, state, local, and federal to solve. That's not us. We know we should stick to our knitting and do what we do, right? So we, have to make sure we're doing that, because we shouldn't put ourselves at risk of losing independence by our own foolish actions. That said, I think people throughout history have not understood how important that independence is. Look, I am not politically appointed. I didn't go through, like Governor Waller, Senate confirmation. I'm appointed by my board of directors of the Philly Fed. It provides a unique perspective and insulation from politics, which is truly unique in America, in our system. And I don't think we should lose that. If we lose that, we've lost a lot.
I do have one crypto question, but I want to just make sure, Jill and Steve, anybody else? So we heard from Governor Waller about his question about CBDC.
Yeah.
And he's still waiting for the two answers on his two questions. Where do you come down on the question of central bank digital currency?
So I share a lot of the thinking with Governor Waller on this, in that I think we need to continue to study it. We need to continue to be ready in the event that Congress does say, no, we need one of these things. We also need to continue to do our research on broad issues. One of our young economists, Daniel Sanchez, works with a faculty member over at Penn, Jesus Fernandez Villaverde, on kind of market structure issues related to if a central bank digital currency is put into place. And they've been publishing a lot in this area. And like everything in life, there are costs and benefits, right? And it depends, the devil's in the detail here. It depends on exactly what we're talking about. So if we're talking about not accounts at the Fed, but through the banking system, it still would put, under certain circumstances, some pressure on the banking system, including smaller banks, community banks and so forth, that may not be able to survive for a variety of reasons if a CBDC is put in place. Now, we may say that's fine, or we may say that's terrible, but we need to know what we're talking about, right? Whether, what are those consequences of putting such a thing in place? So in my mind, the jury's still out. Now that said, I think, we hear from contacts, and particularly, again, in the community bank space, a lot of them are not thrilled with the idea because they understand this just, intuitively, what Daniel and Jesus have found. But at the same time, they're very frustrated with the existing payment options for their customers because of the cost. So let me give you one story. 2 years ago, I think it was 2 years ago, one of our banks, a fairly large community bank in our district, his customers were pounding the table saying, we want to get on Zelle, we want to get on Zelle, we want to get on Zelle. Again, Zelle was initially formed by the large banks. So he said, fine. So he pushed, and pushed through his core processor, and these would play an important role here, right, to get on Zelle. Operates this for a while, And one day he says, I should know how much this is costing me per transaction. He asked the question. After he picked himself up off the floor, it was about $1 a transaction for a Zelle transaction. $1. He said, I can't do this. I can't keep this up. When you added up all the tolling fees and his internal costs and everything to do this, because he didn't have the scale. He's not 𝗣𝗵𝗿𝗀𝗁𝗍. He's not that big. He's big for a community bank. So he's looking at other options right now because his customers still want this option, but it's killing him financially. So this is what we're hearing on the other side, community banks saying, man, if you had a solution for that. Like, the one thing I hear from community banks is, okay, the CBDC may put me at risk, but man, if this could provide some counterweight to me dealing through the core processor on certain things, I'd be all in. It's not obvious it would, but they're the kind of questions the industry's asking. And so this is where I think we need to study it, we need to really understand, and then lay our cards out on the table saying, this is what we know, and these are the benefits, and maybe the answer to Governor Waller's questions are, yeah, we don't know, but that's an unacceptable answer. We need to actually just say, lay our cards on the table to the best of our knowledge, this is what we know what would happen. And then I agree with Governor Waller, and leave it in the hands of Congress, because it's not our call, ultimately. This would be a call that elected officials would have to make.
Thank you for that. One more question.
Just on the, on the CBDC question, we talked a bit this morning about the fact that crypto and blockchains are global technology. The Chinese in particular have been pretty aggressive about digital RMB. We also know that in the current geopolitical environment, there are people that are looking to de-dollarize supply chains and move a greater percentage of global trade off of dollar-based activity, and was wondering if the Fed or a group in government is concerned about the implications of global blockchain technology and the U.S. role and the dollar's role in global trade.
Sure. I mean, I think that's part of the issue that is being debated with CBDC, and many branches of the government are interested in this question, whether it's from a national security point of view or an economic policy perspective. I mean, we've heard from all different voices on this. But again, one of the threats, the immediate threat that people often raise is the digital yuan, right? That could be a threat. It's something we need to monitor. But right now, I think if you ask investors around the world, who do you trust most where you put your money, I think most people would still say the United States. But, and this is a big but, we can lose that by doing things that would undermine that trust. And so if, in fact, what is necessary for us to do is to create a digital form of the dollar to maintain that trust, that to me is the ultimate litmus test for a CBDC. If we have to do it to maintain the trust of either the American people or the global economy to maintain the dollar as the de facto currency, we should do it. But that's why we need to study it. We need to really understand what those implications are.
Please join me in thanking President Patrick Harker.
Thank you so much.
Thank you so much. That was excellent.
sit up there? Or
Okay.
You're live. So is Mark.
I'm in person too. All right, well, good afternoon, everyone. My name is 𝗵𝗁𝗁𝗁𝗏. I'm with the Federal Reserve Bank of St. Louis, and this panel is going to be on, as Steve said, the real economy. So we're going to try to meld the discussion a little bit between the morning session, which is financial markets, and now we're turning it into economic growth and economic development. There's also going to be a lot of technology discussed. So I think the game plan is Mark Mills, who is a senior fellow at the Manhattan Institute and a faculty fellow at Northwestern University's McCormick School of Engineering and Applied Science, will have roughly a 20-minute presentation, and then the panel is going to go off of that presentation into different areas, depending on the skill set of the other panelists. So anyway, Mark?
got the slide clicker. Thank you. And thanks to the GIC for the invitation and honor, and thank you to my fellow panelists. If you'll bear with me, I think we've talked about some of these things last night, and you and I haven't, but we'll get to it. I'm going to do just a dozen quick slides to illustrate some facts that are they may appear slightly orthogonal to what we've been talking about, but I want to explain the title, The Machinery of Money. It's a point of order, let's say. I'm not a lawyer, I'm a physicist, so you'll excuse my redounding to underlying reality and the physicality of our world. I didn't call this the technology of money because everything we've been talking about so far is not technology, any more than an algebraic code is technology, a contract requirement by law, a regulatory edict, or a Shakespearean sonnet. None of those are technologies. If you render mathematics and language instructions into a machine, you get the things that we are calling technology. It's the underlying machines that determine the means of exchange, and it's the machines that humanity invents and builds that determines the nature and the size of our economy. May sound self-evident. I want to show you why I think it's important to make the distinction, and also to illustrate, I think, where the world's going with respect to specifically the misnomer of the technology of money. Money has been influenced, the nature of money, how we create money, how we trade money, by technology for all of written history. So it's not news. And my book covers, I did a lot of research on this, and you'll find much of it in my book, but I think what you'll find is the underlying facts are, let me see, the slides are not going. Can you do a quick check on, oh, here we go. All right, so machines do two things, broadly speaking, and I'm reducing this to sort of a reductio ad absurdum. Machines facilitate finance, facilitate transaction. Machines can create wealth. These are related things, but they're different. Machines, like computers, are tabulators. This is a picture of the UNIVAC in 1952, which tabulated for the first time in human history an election result. Walter Cronkite, who's pictured here, hesitated to release the results. The machine predicted that Eisenhower would win. He thought all the experts were right, that Adlai Stevenson would win. He was wrong, the machine was right. And this was the first use of a machine called a computer outside of the military. It was the Census Bureau machine that was purchased by the Census Bureau in 1952. The very first commercial computer for commercial purposes was a banking computer bought by Bank of America to process checks. The reason they bought the machine, it was crazy and ridiculously expensive, is because they could process 40,000 checks an hour, and humans were doing it at 200 checks per hour. So it's beyond obvious why they used that to facilitate recording transactions of checks that are moving through their system. And cryptocurrencies are just like that. It's a set of rules that we can use to process a transaction. This is a graph of the overall total equity market cap value of all cryptocurrencies from 2016 to date. It's about a 2-week-old graph. Collectively, it's a store of value that's less than 0.1, actually it's more like 0.05% of stored value of all forms of financial assets in the world. So it's, $1 trillion is a lot of money, but the world's a big place. What I want to talk to you about, and what I'm more interested in, are the other form of machines, call them tractors, that create wealth. And tractors are a classic example of wealth creation, of productivity creation in the global economies. You all know why. And this particular tractor, by the way, is a picture of an autonomous John Deere tractor, which will also be a wealth creator. We'll get to that in a minute. So the real interesting issue for me, is, and a lot of what I wrote about in my book, is what are the underlying technology trends that portend not just new means of exchange, facilitating exchange, but also of wealth creation. The world's $100 trillion world in GDP terms. It's been growing. Its growth does not look anything like the bubble that was the cryptocurrency bubble. So one last point on sort of technology as the means of exchange, and I'm using, for those of you who are scholars of this literature, this is a Marxian language, right? He talks about the means of production, and the means of doing things in almost Victorian language is actually very evocative. There's no question, and this is all Federal Reserve data, by the way. I'm a huge fan and student of, and a voracious reader of Federal Reserve studies from the St. Louis Fed, from the San Francisco Fed, from all they're terrific researchers, great data. On your left is the share of all business. These are all business transactions, not financial transactions, conducted online in the United States. Beyond obvious, it's moving into the machinery of the cloud. On the right is Federal Reserve data showing the percentage of total financial transactions that are being done in different forms. And these forms are all non-cash forms, which is to say electronic forms on machines. The ACH red line, this is ACH credit transfers, is taken off from 2000. This is what I would call the new century of the cloud. The ACH transaction as a revolution in the means of moving money around, of facilitating a credit transaction, if you like, was pioneered by the San Francisco Federal Reserve. Some of you may know, in 1972. How could they do that? Well, because they had computers, and they had a communications network that didn't exist before, and they had code, which was pioneered by a guy named Licklider at MIT, which made it clear that you could move large quantities of data with a near zero error rate. It was the progenitor to the HTML code that made the internet possible. And so when you had enough of a network and enough cheap computers, the share of all transactions, financial transactions that are electronic rather than cash, just took off. And this is the transformation of no small consequence, but it's machine-driven. Mobile payments, by the way, with smartphones, we all know that this is not just contactless, but the smartphone payment where your credit card's in your smartphone. That took off in the 𝗖𝗵𝗿𝗶𝗀𝗀 lockdowns, and we're now at $50 billion a year of that, and we're going to be rising up to, by all estimates, over $500 billion in those forms in the coming decade. Let's see if we can get the slides to move again. So let me switch to the machines as the means of productivity, changing from production to productivity because I'm conflating an observation that most people know if they studied economics. I'm an amateur economist, but I studied a lot. And we know what drives economies. Solow got the Nobel Prize for documenting it. Technology, and by that he didn't mean Bitcoin, and he didn't mean writing code. He meant technology in the broad, correct sense of the word. Technology is a primary driver of the wealth and the productivity of the world. There are patterns in technology, and my book is really about these patterns, but I want to illustrate it with just these 4 examples for you. Patterns take time. Things are nonlinear in the technology world. Things emerge that are different. They take a while to perfect. Then when they get perfected, there's a tipping point, a takeoff point, where a lot of it gets used. This is beyond obvious when stated, but what's interesting at the patterns is the patterns are pretty consistent in timeline. I mean, the first Model T, which is arguably when the auto age took off in 1920, it came 25 years after the invention of the car. There were millions of cars in the world, thousands of car makers up to that point in time, but the auto age began when there was a really useful car that a lot of people could buy. Aviation age was 25 years old by the time the very first useful commercial airline jet was invented and built, commercialized by Boeing, the 707. That's when the aviation age took off by all measures, whether it's route miles, dollars, transactions of services. Computers is the same thing. It was roughly 20 years after the first electronic computer before there was a really useful commercial computer. It was the IBM mainframe. The era we're in now is just starting 25 years after the first cloud data center. For those of you who know Santa Clara, Exodus was the first cloud data center. It was roughly 25 years ago, but almost 30 now. We're now beginning into the age of the cloud. All these machines do what all machines have done through all of history. Essentially, all of our society is anchored in services. The U.S. economy, by any measure, whether it's employment or dollars of GDP, has been services dominated since the Revolutionary War when we became a country. The data, again, this is actually a Federal Reserve study, but the data make it unequivocally clear that the principal shift in the structure of the economy was more manufacturing jobs and fewer farming jobs. But services utterly dominated and have dominated. Machines make possible the services, whether they're financial services or food services or transportation services. So let me tell you where we are in economic terms, because physicists and engineers talk about computing power in bits per second, petabytes. And what you really want to know if you're an economist is when you're buying a service, if the service is a transportation service, in this case a computation service, there's some basic common measure of what I'm buying per dollar. The measure of what you buy per dollar, in this case, is computations per second. Whether it's a machine you buy in capital, whether it's a leased machine, or whether it's a leased service of a machine that's remote from you on the cloud. You can follow this through all the history of modern computation, and the graph looks like this. It's a logarithmic curve. You're smart people. You all know what logs are. I don't have to explain that. During the first age of electromechanical machines, the economic value of these machines increased by 7-fold per decade. You got 7 times more value, computations per second per decade. The first electronic age, IBM mainframe age, it increased by 16-fold per decade. That's almost 2,000% per decade increase in economic value. The age of the cloud has been going up at 1,000-fold per decade. This is far faster than Moore's law, because what you're seeing here is essentially a utility function, computation moving into a kind of a utility function. That's pretty consequential. I would just say it's very predictive. It'll tell you a lot about where the world's going. And as an example of what it tells you, consider a similar metric in transportation services. You could similarly measure the economic cost or value of transportation services, not in computations per second per dollar, but how much it costs to buy a fare to do something, to go somewhere, to move a person or goods, in feet per hour per dollar. That's what this map shows you. It's also logarithmic. You can see that what happened is that over the period of the 20th century, we reduced, over the 100 years, we increased the economic efficiency of transportation services by 1,000-fold over the entire century of the 20th century. We're now doing that kind of thing every 10 years in information services. This is consequential. I think it's consequential in ways that are sort of hard to sort out. They're consequential in ways that when we think about Bitcoin transactions or cryptocurrency transactions as maybe a measure of a machine-driven service, because it's purely a machine-driven service made possible by computers and communications machines. The code is a mathematical formula that Nakamoto ostensibly created, and the formula can be done by hand. It would just take you a long time. The problem with Bitcoins as a transacting instance is that it can operate at about 7 transactions per second. Maybe make it a little faster. Ethereum is maybe in the 20 transactions per second range. So it's not a very good means of exchange, considering Visa transacts credit card at 24,000 transactions per second. So could we do better with Bitcoin? Yeah, when you get more powerful computers, are more powerful computers coming? Beyond, obviously, especially as they move into the cloud. So I think there's an interesting discontinuity coming in terms of the point in time in which things like blockchain, cryptocurrencies, have as high a velocity as credit card transactions, which is not impossible to imagine anymore. If we can get the next slide. And let me tell you why it's not impossible to imagine. I'm going to come back to pure machine realm and tell you something that you may or may not know. There's a company called Cerebras. It's a startup company. It's a commercially viable startup company. It's a company that is manufacturing what I would call an inference chip, not a computer chip. So in the worlds of artificial intelligence, you're doing inference, not computation. I know roughly where I want to drive. The answer isn't 1 + 1. The answer is stay about here. That's inference, not computation. You can make computation chips do inference. It's like using a helicopter to fly across the Atlantic. It's very inefficient, takes a lot of overhead. Once you go to graphics processing units, which NVIDIA essentially invented 25 years ago, you change the game. We get artificial intelligence. We get inference engines. We get things like Siri voice and Alexa, because we get pattern recognition on your smartphones. This chip is the size you can see of a dinner plate. This is not Photoshop. This is an inference chip made by a company called Cerebras. This inference chip is one chip, is the size of a small pizza. It's not a chip, so the misnomer, but it's called a chip. It came into commercial being 25 years after the first AI chip. Pattern is following. What this chip does is process images, does inference 10,000 times faster than the fastest NVIDIA GPU. This is commercially existing chip, 10,000 times faster. For those of you who are like me, are sort of energy people who work in the energy domain, this one chip uses 15 kilowatts. Depending on your house, this is 3 houses, or it's one very large house in La Jolla, running 24/7. There's a few people here who have houses that are bigger than 15 kilowatts, but I won't name names. This chip has 3 trillion transistors on it. It's astonishing. What this chip allows you to do is inference faster, cheaper, easier, even though it's $1 million. It's a very expensive chip. A group of these chips were assembled in December, 16 of them, to make what's called an exaflop supercomputer. The world's fastest supercomputer in the world up until that point was a $600 million, 47,000 processor computer at the Oak Ridge National Labs that requires 25 megawatts to run. 16 of these requires 2 megawatts that cost $30 million to build. They built it in 1 week. Where is this supercomputer going to reside? It's going to reside in the cloud. It's not going to sit in your smartphone. It'll sit in the cloud and it'll do inference. It will make ChatGPT smart, in short. ChatGPT is smarter than Siri, Voice, and Alexa by a lot. All of us have had the experience of trying to convince Alexa or Siri to understand English. ChatGPT is better. ChatGPT is still C-, maybe D+. This kind of horsepower will make chatbots, which are central to making a lot of financial transactions easy, actually useful, which I think is consequential, if not revolutionary. And it's the infrastructure where they're going. I'll just give you some economic numbers and wrap up so you can see where you can get where I'm going with my contention, which is a central contention of my book, is that we are at a dislocation in terms of functionality of a new infrastructure. By the dislocation, I mean the extent and scale of a new infrastructure. The cloud is a new infrastructure. The cloud is not the internet. The cloud uses the internet. The cloud does inference. It doesn't just store cat videos. It's a utility function for providing information amplification to the economy at large, and it does stuff like make crypto coin work. Well, that's nice, but that's just one use case. This is the US spending by US businesses on IT services and hardware. I mean, you can see the curve from 1950. There's no sign that this is peaking soon. US businesses don't spend money on services if they're not useful. I'm not an economist. I used to run businesses. Businesses don't buy non-useful things. So they have values. You are spending $1 trillion a year now in the United States on buying information services. That's meaningful. Global cloud is an infrastructure now where capital spending on it exceeds global capital spending on all electric utilities combined, just to give you a sense of perspective. And the growth rate of spending on the cloud is far greater than the growth rate of spending on electric utilities because the growth rate, underlying demand for its services, is far, far higher. If you're thinking in real estate terms, because a lot of people think in those terms, the cloud is just, it's a network of buildings and communication systems and end devices. But if you want to think about the core of it, the utility core of it, these are buildings that are typically the size of skyscrapers in square feet, a million square feet under one roof. They cost about as much to build as a skyscraper. They rent for 5 times as much as a skyscraper per square foot. They consume 100 times more power per square foot than a skyscraper. Which gives you some, again, sense of where the world is going and its energy appetites. And maybe much more important is the marginal economic impact of $1 spent in a utility versus $1 spent in the utility of the cloud. You don't have to spend any time as an economist to know that the marginal new dollar spent on a ton of steel, a new car, any new physical asset, the new asset's often a little bit better. That's what businesses do, but it's a little bit better. The marginal dollar spent on the next unit of IT service is not a little bit better. It's getting better at the rate I showed you, 1,000-fold per decade. It's an astonishing economic accelerator. That will show up, well, you can see the numbers here. I mean, in terms of enterprise class data centers and skyscrapers, the cloud is blowing away the traditional utility function. One quick factoid, and then two ideas on labor and employment that relate to our previous panel on we don't have enough people, which I agree with. In fact, Elon Musk has said several times we don't have enough people in the entire world. The world is in a very bad path for lots of demographic reasons, not least we don't have enough people in the Western world. One of the functions of the cloud, one of the functions of AI is going to be and is already starting to migrate into one of the long-standing challenges in labor markets, and labor markets for things that involve manual labor, which is the absence of robots that are useful. 90% of the manufacturing businesses in the United States don't have a single industrial robot. You can inverse that. 90% of industrial robots are in 10% of the businesses, because what are they doing? They're doing highly repetitive tasks that very large businesses need. Robots that are useful, which are mobile and are adaptive, that can work alongside people in multifunction tasks, have not existed until now. Call them mobile robots. The mobile robot market is on a tipping point of taking off. This is one of several forecasts in terms of millions of units shipped. I suspect it underestimates it, but we'll see. The robot of the last era was the robot that you bolt down and it does a repetitive task. The very first robot to do that usefully was 1961. It was a 𝗖𝗵𝗿, and it showed up on Johnny Carson's TV show, contemporaneous with it being installed for the first time in history in General Motors' Lordstown factory. It made that factory the most productive factory in the world. Every automaker on the planet chased that, and the vast majority of industrial robots are in fact in auto factories, which do highly repetitive tasks. It is entirely a coincidence that 2 cycles of technology later, from stationary mobile robots to useful robots to useful mobile robots, 50 years later, the first commercial one, probably the first commercial one, showed up on Johnny Carson's stage with Jimmy Fallon show. If any of you have never seen the show, you can find it on the magic YouTubes that's stored in the cloud. But you can also go on YouTube and look at Boston Dynamics Spot Mini. This is actually an anthropomorphic, dog-like robot that can walk around and do things. And it's being sold and leased into businesses. And why would you do that? Because it can do routine functions, particularly like inspection, cheaper and easier and more reliably than human beings can, freeing up the human being to be upskilled and paid more to do other things. So I'll show you 2 more graphs to tell you why this plus ChatGPT are in fact revolutionary, and I would take this bet. 5 years from now, Federal Reserve data will look back in time at roughly this period as a pivot in which we solved an interesting problem. How do we get more people to do the jobs that are underserved? This is the Federal Reserve study that was published in 2018, which categorized all of US labor into just 2 categories, routine labor and non-routine labor. And then the 2 separate categories, knowledge work and manual work. It's a pretty obvious category, and it's pretty easy to do those buckets. And what you can see in this graph is that essentially 0 change in the absolute employment in routine manual labor or routine knowledge work for 20 years. No change. Sorry, 40 years. The same number of human beings doing routine work. All the growth in labor is in the non-routine work that's knowledge work and non-routine work that's manual. If we don't have enough people, and robots and ChatGPT are very good, AI are very good at automating routine tasks. I want to get the routine tasks amplified, done by robots, virtual and real, and I want to move them into the non-routine tasks. Doing that frees up capital, frees up people, allows wage growth without wage inflation. So I think the Fed's challenge, tamping down inflation, will be solved, I'll be slightly provocative, much more effectively by the engineers making these machines than by constraining interest rates and abusing businesses with higher costs. But that's just me. Since I'm on the other side of the equation, I'm paying for high-cost capital. So 2 quick graphs and I'll stop. So this is again Fed data just flipped, not to show unemployment rate, but to show the ratio of U.S. jobs available to the number of people that are available to be employed. We have more jobs than people available. You all know that. And finally, globally, the global trend, this is the working age population as a percentage of the total population in China, the United States, and less developed countries. Focus on China, the United States. There's an utter collapse in the availability of labor in the working age population cohort. These demographic trends cannot be reversed easily or quickly. They take centuries to change, not decades. We are going to need ChatGPT on steroids to amplify this, which is coming. Wait till ChatGPT 4 comes out. And of course, all of the AI guys are jealous that Microsoft got all the attention in there. And we're going to need more robots. Even Elon Musk, you probably saw last year his announcement that they plan to build an autonomous mobile robot. So the last point I'll make is that the signal that what I'm claiming is happening, has started to happen, could be seen by 3 different metrics. One will be the trailing 3-year average productivity growth rate of the United States will tilt back up. This is the trailing productivity growth rate in the United States. I think it's going to tilt back up. I think the data show that. The other indicator will be in another hype cycle for something called AI. That's already started. So AI will not just be a big business, it's the next hype cycle. And if I were looking for a sort of one bellwether that what I'm saying has happened or will happen, it will be the first robot IPO. By that I mean the robots like the C-3PO stuff. Not the Terminator stuff, but the C-3PO stuff. And you're going to see an IPO like that because it's possible. There are robots like that. This is Agility Robotics robot. And one of them will IPO because they can and because they'll have products. That's not going to be, that will have been made possible by the transformations of the machines of the world and by the transformations of the code, the rules, and artificial intelligence in those machines. So I think it's a profound dislocation in wealth creation. I think there's going to be more growth than most forecasts realize. Economists, not to be unkind to them, because most of your economists have historically been profoundly bad at predicting economic dislocations caused by technology. Very few have been successful at doing that. They've been very good at hindcasting. So I don't mean to insult them, because those rules do matter. Thanks.
Thanks, Mark. All right, so one of your abusers is back to moderate. So let me start with, since Mark, you started with tractors.
Deliberately.
And we just happen to have someone on our panel who makes machines of a different color.
I tried to find a cat autonomous tractor. I'm sorry, I should have called you.
Mostly trucks these days.
I know that. I should have put your truck up. I'm sorry.
So if we think of productivity, historically, manufacturing has been the star of the show, forefront of productivity gains, from robotics to materials, and you can even go back to electrification of factories. And so I'm going to go to Laura to, if you think about sort of machines and machinery, they're used in energy extraction, construction, infrastructure. First of all, introduce yourself and just give a brief introduction of what you do, and then talk about some of the efficiencies that your company is working on in this regard.
Sure. My name is Laura Speak. I'm the chief economist for Caterpillar for their energy and transportation group. We have 3 different divisions, so I support primarily the energy and transportation. Resource Industries is our mining group and large trucks, and then we also have a construction industries group. And when we started talking about productivity, thinking about how we utilize technology to improve productivity, if you look at one of the biggest investments, and this can be for tractors or it can be for the things that we make, there's a lot of downtime. These major investments in assets sit idle a considerable amount of time. And so one of the best things we can do as industrial manufacturers is figure out how to increase that productivity by increasing the amount of time that we're utilizing those assets. And so if you look at different companies, and I'll talk about a few in a minute, figuring out how to make better use of that asset and utilizing it more, whether it's manned or unmanned, is key to unlocking that productivity. And so Caterpillar introduced their first prototype autonomous truck in 1994. And so we've been in this business for a long time. In fact, in April of 2020, I think we announced that we had hit 2 billion tons of materials moved autonomously with our machines, with our trucks, and and that was it doubled in about 18 months at that point. So it went from 1 billion to 2 billion. We've gone from 2 billion in April of 2020 to 4 billion at the end of 2021. So it is an increasing activity. This is something that there are over 500 connected assets that work autonomously around the world today. So again, increasing that productivity and learning from that process has unlocked additional resources. Volvo announced just this week, they're going about things a little bit differently. You know, most of our connected assets, most of our large mining trucks are large. They're really, really big. But if you look at what Volvo announced this week for their mining trucks, they're bringing out autonomous small mining trucks. And their idea and what they're putting forward as their value proposition, they're battery powered. So the one thing with large mining trucks is they require a lot of power. And so if you're going to electrify these things, they require really big batteries. And so Volvo is taking the approach that they want to have smaller trucks, smaller batteries, less weight, and more of them. And the value proposition that they're putting forward is if one of those trucks goes down, instead of if you have two 100-ton trucks and one of them goes down, you lose 50% of your capacity. If you have 10 smaller trucks and one of them goes down, you lose 10% of your capacity. So again, it's how do we keep these things up and running more often and utilizing those assets in the best way possible. So technology is key to that, but it's also helping us increase that productivity. If you look on agricultural side, Deere announced that they're going to they have a new product that introduces fertilizer at the time that they're getting ready to plant the seed. And so now you don't have to come back with a new piece of equipment after the fact and spread that fertilizer. Because you're putting it right where it needs to be, it uses 60% less fertilizer. And so again, it's increasing the productivity with less resources overall.
Okay, thank you. Now I want to go to the other end of the spectrum, from very large multinational companies to small business, and some huge percentage, and Holly will tell us the exact percentage, but some huge percentage of U.S. businesses are classified as small, and I realize the definition can vary depending on which economist you talk to. So Holly, why don't you talk a little bit about sort of the challenges that small businesses face in boosting productivity, whether that's the cost of acquiring technology or other things, and introduce yourself first as well.
Sure, thank you. I'm Holly Wade, and I run the Research Center at the National Federation of Independent Business. And we're a small business association advocating on their behalf of the issues that matter to them. And we have roughly 300,000 members, U.S. businesses across the country that span most industry sectors. Most of our members are employers, but about 80% of our members are under 40 employees. So we don't have a formal definition. You know, most people go with the SBA. They try to claim every business is a small business with less than 500. But when we talk to our members, that's generally the picture that we're looking at as far as who we represent and the information that we can glean from them. Running the Research Center, it's helpful to have 300,000 members that we can survey on a lot of different issues. And one of our staple products is a monthly small business economic trends survey, where we ask regularly the same questions we've been asking since the fourth quarter of 1973, in which in 1986 we switched to a monthly survey, so our chief economist was far busier than he was before. But it allowed us to have a lot of information about shifts in business operations over time as far as the small business sector is concerned. And two of the areas are capital expenditures, planned and actual capital expenditures, and what they're spending their money on. Two of the differences, or one very large difference between a large corporation, as Laura was talking about, and a small firm, is the scale of their ability to utilize technology in their business. And also the time commitment it takes for a small business owner to look at the technology that might be available to them or appropriate for their business in a cost structure that makes sense for them. And that takes an extraordinary amount of time, and time is one of the most valuable assets of a business owner. And it's usually them that's doing the searching for new technology or hearing the pitch about what's available to them, or talking with other small business owners in their area about technology that they're starting to incorporate in their business. On top of that, the financing mechanism for them spending money on new technology is primarily from the business earnings, which in case for a small business owner is the same money that is their take-home pay. So it is, very challenging for small business owners. They are generally conservative when it comes to, spending earnings on new technology if they're not fully convinced that it's going to offer a pretty substantial return on their investment for their business. One of the unique areas for small firms is the dynamic nature of the small business sector, in that, and I sometimes think about it in comparison with, you own a house and at the very beginning you update the floors, you update a kitchen and maybe a bathroom, and everything is at the beginning of ownership of a house. Once you're established, you put in all the furniture and you're living there and everything's routine and comfortable. It's a larger step to then renovate unless it's just really necessary. Oftentimes you hear folks say, well, that's for the next owner. Well, that's not unlike a small business owner. When things become very routine, at the beginning they're incorporating the latest and greatest technology that is available to them at the price point that they can afford. And then once things are routine, incrementally as equipment breakdowns or technology really escalates to the point where it makes sense to introduce it in their business, oftentimes their thought process is, well, that's a huge expense. Maybe the next owner is the one who can make those decisions, but it's working fine enough for me at the moment. So we saw this, one of my prime examples is during the credit card processing chip migration, and talking to small business owners about, have you updated your credit card processing machine to incorporate chip cards? And so many of them said, no, not gonna do it. Payment function works well enough for me. I don't need it to go, that much faster, that much more secure if it's gonna cost me X dollars more a month for processing. However, when you have a huge shift, for instance, with COVID and the pandemic, we did a number of surveys related to how they were dealing with the labor shortage, but also some of the restrictive kind of business operations that they were facing in operating their business during the beginning of COVID. And with the influx of PPP funds, the Paycheck Protection Program, the EIDL, all the acronym programs that supported small business, and their ability to use, not those funds because they were dedicated to payroll and keeping their employees tied to their job, but if they had any extra cash and it made sense for them to do it, there was a huge surge in those who updated primarily their payment processing systems, whether it was in person or online, developing their online capabilities and trying to streamline processes as much as possible. So we did see a huge escalation in the last couple of years with those who are investing more money in their business. But the dynamic nature of small business is, largely where we're seeing those new businesses incorporating the latest technology when they start out. And those small businesses, many of them close shop in the first 5 to 10 years. And so that churn of small business dynamism, of the ins and outs of those starting and exiting, is a lot of where we're seeing some of the increase in productivity, but it's not within the same firm, it's with new firms.
Okay. So let me now turn to sort of technology more broadly. So in the economics literature, one of the means of generating economic growth, output per hour, whatever, is what's called the idea generating function. So it's the search for and implementation of new ideas. And a lot of this is basically what we call intangible capital. So it could be research and development, software, organizational capital, whatever. So the great thing about ideas is they're often non-rivalrous. So somebody develops it, then everybody else can use it if it's scalable. So technology in that sense is very global in nature. Now, I'm going to bring Leland into the discussion because there's a lot of discussion recently about export controls of certain things, whether that's technology or equipment, technology embedded in equipment. And we heard a lot of discussion this morning about how digital assets are censorship free. But there's a lot of censorship that seems to be developing in the technology space. And we see that a lot with the US versus China, or the West versus China. So Leland, can you, first of all, introduce yourself and what you do, and then talk about sort of how these export controls on technology can cut both ways, maybe from the US to China, but also from China to the US.
Sure. My name is Leland Miller. I'm CEO of 𝗖𝗵𝗿𝗶𝘀, which is a data analytics firm that does large-scale data collection across the Chinese economy. And we build up models and figures that are an alternative to China's national statistics. This was a fun presentation to watch from that Mark put on, because I very much share his vision of this technological future. And I think it's very important to be looking at these issues right now during a time where we talk incessantly about high inflation, because technology, as Mark said, is highly disinflationary, and this will be one of the forces that is going to be as a corrective in some ways in the medium and long term, if not the short term, in terms of our inflationary environment. So this is an exciting time. I think we are on the cusp of a new era of technological advancements. But what worries me is there's a challenge that needs to be acknowledged right up front, and that is we're also on the precipice of a new era, a heightened era of US-China competition over advanced technology. From the Chinese perspective, they're ready to go. This is the fourth industrial revolution, and they want to dominate the world in this, the same way the United States wants to dominate the world in advanced technology. From the Chinese perspective, they weren't a player in the first or second or third industrial revolutions, which was, of course, 18th century mechanization, 19th century electrification, 20th century informatization started. And then this is the new fourth industrial revolution over advanced technology. The Chinese want to be part of this. They want to be major players. They want to be the major player. And back in 2015, they articulated a program called Made in China 2025, which was essentially this idea of focusing national efforts and resources on becoming the power in this with certain timelines over the next 10, 15, 20, 25 years. Unfortunately, Made in China 2025 was a lot easier to detect than previous programs that Chinese have put out over the past 30, 40 years, which were more indecipherable. And politically, this became an issue in the United States. And American policymakers started looking much closer at what was happening on the Chinese side. And they're saying, okay, well, what is in Made in China 2025? What are these advanced technologies? Well, we're talking about artificial intelligence, 5G, robotics, quantum computing, quantum cryptography, biotech, et cetera. Well, these are really, really important technologies. You know, we can't let the Chinese do that. And how are the Chinese planning on achieving this domination? Well, it's in large part through massive amounts of government support, which is another way of saying lots and lots of subsidies. So the US political thermometer started going up about 5-6 years ago, a little bit at a time, and started saying, well, wait a second, there's this company called Huawei, and it's establishing telecom around the world, but it's doing it not just because it has a good product, but also because it's gaining enormous subsidies for the Chinese government. We have to target this company. Also, it didn't hurt that Huawei's involved in industrial espionage and stealing trade secrets, and so they made a very good target. But I think that the lesson from that is, well, wait a second, we're not just dealing with one company, we're dealing with a lot of companies. So we can't just target one company, we need to target sectors. And the other realization that came out was, wait a second, we've been under this illusion that in China there is a divide between what's civilian technology and what's military technology. But it's become very, very clear that there is not really this divide. If the party, the government wants to commandeer technology, wants to integrate it, which is routinely done, then it's not easy to divide things between black and white. So saying, okay, well, we're going to let them have things on the civilian side, but we're not going to let them have things that have military applications, it became an impossible, and ineffective line to draw. So what has been happening over the past several years has been an increasing focus from the US side, and there will be a counter push from the Chinese in time, to ring fence China from these advanced technologies. The great input into all these technologies is the microchip, it's the semiconductors. And so the beginning of the export controls has started with this idea that advanced technology can be kept out of the hands of the Chinese if we provide a ring fencing of semiconductors, chip making equipment, and other things, delivery, the inputs, the chip making equipment, we keep that away from the Chinese so that they can't make some of these advanced products, which on the one hand could end up beating out the United States commercially, but much more of concern was the fact that these are the type of things that go into weapons that could eventually be used to kill American soldiers. So what has emerged is an incredibly imperfect solution, which is that as provocative as it is, there's no way, there's a balance between allowing from the US perspective, allowing the Chinese to gain access to this technology, which could cause a problem down the line, or saying we're going to stop allowing access to this technology because the United States, by and large, controls the supply chains for most of this stuff. And we're going to be provocative by doing it, and we're going to make the Chinese mad, and we're going to create a counter push on this. But which is the better answer? Politically, we've settled on the latter. We've settled that we can't do it anymore, we can't wait, the risks are too much. So the reason I bring this up, the reason it's relevant to this conversation is, in a perfect world, we would have this innovation revolution that was cross-border. It was based on the idea of one country building on another country, building on another country, the progress, division of labor in terms of tools, the way we do with advanced semiconductors. That would be wonderful. But we don't live in that world anymore. And one of the impediments to some of this growth, although I don't think it's going to stop it, that's absolutely not my point, but one of the challenges to this will be the fact that in a world that is in part deglobalizing and in part decoupling, I don't think that there is a broad decoupling of the US-China relationship, but I do think there is a very important tech sector decoupling that is underway right now. Because of this, it is going to be much more difficult to reach some of these milestones than we otherwise would have if the world was full of puppy dogs and flowers. So that's sort of the backdrop of this. Geopolitics will not stand in the way of technological process, but because it will break down the collaboration of all these entities involved, it's going to be a real hurdle to do some things that otherwise would have been much easier.
Okay, thank you. I just want to go back to Mark before we open it up to audience Q&A. One of the slides that struck me is when you were talking about cloud computing infrastructure. You said, I think the cost per square feet was like 5 times the Empire State Building or some large, but the energy usage was 100 times. So when we think about sort of the benefits of of cloud computing and the infrastructure that's around it. And then we move on to the costs. I mean, do these kind of structures and the cloud computing structure, will the benefits be restrained if we see an upsurge in real energy costs? Because obviously we're in the EV push. That's another demand on energy, and I mean, will the benefits be constrained at all if we see a huge increase in energy prices?
Well, no, not even close, because the economic benefits of the kind of astonishing growth rate in economic utility of compute function utterly overwhelm that. I mean, the fact that the energy costs are high in aggregate is hiding the fact that the energy costs per unit of activity are tiny. It's just so much activity. So but it does cause a lot of angst in the tech communities. That's why they do a lot of credit buying of wind turbines in Europe to say that the data centers here are running on wind power, all this kind of regulatory arbitrage to hide the reality. Globally speaking, the global cloud uses twice as much electricity as the country of Japan. And the idea that we will make it more efficient to stop that from happening, because people who don't like energy consumption don't like that, is ludicrous. The reason that we use so much energy in the cloud is because we made everything more efficient. We wouldn't have any smartphones if they worked at the compute efficiency of 1980. Your one phone would use as much electricity as a skyscraper at the compute efficiency of 1980, so there wouldn't be 4 billion phones in the world, there'd be none. A single data center at 1980 compute efficiency would use all the power of the US grid, so we wouldn't have thousands. So what's happening now I won't use an invective, it has the tech community anxious, is that the use of artificial intelligence, which is dominantly here, and Chinese know this, they couldn't build a chip like that in 20 years. I mean, there's an astonishing leap over where they are. So we do want to keep it from them, in my view, to your point, Leland. But the amount of compute power being devoted to machine learning, so ChatGPT had to be taught language, so it goes through a learning phase. Then its inference phase is when it's running. It stopped learning, but you have to keep retraining computers for specific tasks. A single learning exercise for a single small task on the computers uses more energy than flying from here to Tokyo in energy terms. The compute power devoted to AI is increasing at 300,000-fold per year. I mean, there's such a huge appetite to tap into what artificial intelligence, which is a misnomer, can do to add economic utility that is just a giant sucking sound, so to speak, technical term. But it will cause anxieties, but they'll stay disconnected from those two domains. I work at the intersection of those two worlds, which is kind of feels schizophrenic at times when you work in the energy world and the tech world. But they intersect around the fact that everything uses energy. But the one fact I'll add to what Lynn was saying that's interesting, and again, the Chinese know this, and we have an opportunity, if exercised properly. Half of all the world's data centers are here in America. The hyperscale data centers, these are the big kahunas, more than 3/4, about 80% of them are here. 90% of the AI activity that has high utility value, that is, do useful things with computing to read X-rays, is here in America. On the bioelectronics revolution that's underway, epicenter of it's at Northwestern University, 80% roughly the IP, and that's the future, is here. So China's busily manufacturing more of the things that were invented in the past, while America's still inventing the future. We could lose that by misgovernance. We can lose it by giving it away to the Chinese under bad agreements, and especially if the things are weapons usable. I used to be a weapons researcher, so I share entirely Leonard's concern about the politics of this, the geopolitics of this. They're really important.
Mark was saying before this that he was involved in the Sidewinder missile program, which has been known to shoot down a balloon or two.
It's a nice missile. We make lots of nice missiles now. Chinese are making them with our chips.
So I just want to go briefly back to Laura. I mean, Caterpillar, I think, makes excavation machines, and I think there seems to be a burgeoning market for mining of rare earths. Is that true?
There is. And right now, most of them are in places that we don't like to do business.
Yeah, like China.
as the United States. China primarily, but then as you start to look at electrification of things like automobiles, you start to talk about cobalt and in the DRC and other places that are challenging for us to work in.
Yeah, you bet.
All right, so we're going to open it up to Q&A, and I have a light shining in my face, so I can't really see if anybody has. There's a question right down there.
Okay.
If you could state your name and who you're with.
Hi, Will Peck again, WisdomTree. My question was actually really, I was thinking of it before Mark's latest commentary around China. I've been struck recently by, there was an article in the Journal 2 weeks ago about, I think it was 2 weeks ago, about all the Chinese infrastructure projects around the world and how they aren't working very well right now, and you're starting to see leaks and things like dams and stuff like that. Also, the Chinese vaccine just did not work very well at all compared to Western world-made vaccines. And human coordination is hard. So even something, we talk fear, kind of Chinese command control, it seems like it's hard to get humans to do things in a good way. Does that make us, should that give us comfort in terms of our dealings with China from economic kind of great power competition? Or is that, in another sense, is that just scary? Does it mean that they're doing stuff without having necessarily control over what's coming out of it?
You and I probably agree on this. It's an interesting indication. Go ahead.
I think the yes and no, in terms of giving you confidence. I think 95% of the time, a Western market system focused on innovation will beat out a Chinese autocratic, state-led system in terms of developing things, in terms of building things. The incentives are better, et cetera. The reason it's sort of interesting within the context of this conversation is the one thing that a state system like China is very good at is picking a few things and throwing enormous amounts of money at it, and then doing them better and better and better, and not efficiently, but more and more and more. Now, there are reasons why if you ring-fence certain choke point technologies, they're not going to be able to generation jump and build bigger chips. But the broader issue is that when China started to said a few years ago, 2015, Made in China 2025 program, they said, we are going to focus on these technologies, and we're going to put a national security focus on this, and we are going to fund them like crazy. It was a reason to be very worried. Because this is the type of thing that if America, if Western allies didn't take seriously, then they could get trampled.
I agree.
Yep, right here.
A question, now let's stick with China for a second. Leland, you talked about what we're going to do to the Chinese as far as chip controls and everything. What can they do back to us?
They have 85% market share in manufacturing of polysilicon for solar photovoltaics. They have 75% market share on almost all the so-called energy minerals, because it doesn't matter where they're mined, they're refined in China. Cobalt, nickel, copper. I mean, they produce, I think, 50% of the world's aluminum. Electric cars take 400% more aluminum than conventional vehicles. They announced a policy 20 years ago to pursue the mining of rare earths, which are not rare. They have rare properties. The U.S. has lots of rare earths, as does Canada. We just chose not to allow the expansion of the mines with our regulatory environment. They made a deliberate choice to pursue that because it's far easier than building chips, and especially given the self-inflicted wounds we created in the United States. So they have enormous market power, both for pricing and the supply of critical metals. U.S. imports 100% of half of our metals. 100%. We report over half of another 2,000 critical metals, and they cannot be stockpiled. They can be stockpiled to build a missile, because you only need tons, but to build cars and buildings and computers, you can't stockpile megatons of these metals. There aren't enough in the world. So they have market power. We have market power. They buy lots of our natural gas and our oil, directly and indirectly, and refined fuels. They can't produce enough of it. I mean, it's like a heated up Cold War where we haven't played all the cards right, in my view, and we need to play more of the kind that Leland is describing in a more artful way that we've been doing it in this administration and the previous one, so I'm going to be agnostic on inartful China engagement. It's been very, very feckless. The Chinese are terrific partners for a lot of things. I'm happy if they want to produce a neodymium for wind turbines offshore of Cape May. Yeah, it's, whatever. But they subsidize the hell out of it, and they do not follow our environmental regulations. And if they got even close to it, I'd be a much happier guy. But they have a lot of leverage on those things, which would have huge economic consequences to us. The big difference is, and Leela and I just talked about this last night, the things that they have that we need, we could do. We could remove regulations and do them in say, 5 years. The things that we have that they want, they can't do in at least a decade or two. So that's a big asymmetry in terms of the geopolitics. I mean, they're heavy machinery. I've driven some of the big front loaders that CAT makes. It's a lot of fun. I love driving those guys. And I've driven the Chinese ones, and the Chinese ones are cheaper, and no one will buy them outside of China because they have no idea what the quality control is, and those things are $1 million machines, and they break all the time. It's a huge advantage for us. They've hinted at it. Yeah.
So I was going to say, I agree completely with what Mark's saying, and the corollary to that, which I was going to add if you didn't directly ask it, was simply that they have not pulled these levers yet, but we're getting there. And the reason they haven't pulled them is, net on net, we have much more leverage over China than China has over us. Exactly. For the reasons Mark explained, for other ones, the size of the relationship, the size of the bilateral trade deficit, you could just tell the scope of the trading relationship. But they have very few cards to play, and they don't want to play them prematurely. But we're getting to a point, based on the things that are coming, the export controls on chips, on AI, on quantum.
They're going to push them.
We're pushing them, and it's provocative, and they're going to push back. And in the next few years, we're likely going to see export. We're going to see export controls and export bans on things in the green world.
Didn't GI's department just issue an order to examine the export criticality of rare earth specific? So they didn't issue an order to restrict exports to the world, but to examine them on the same basis, sort of bilateral basis, of our export restrictions on national security grounds. So they've signaled, right, that it's a card they could play.
It's coming.
Yeah. It's not a good card. I mean, we could mine the stuff here. I love mining. I work for a mining company. But, you know, the amount of time it takes to open a new mine in America is measured with the symbol that looks like infinity.
David Burson, Cumberland Advisors. I won't ask when the machines become aware, because we know the answer from watching the movie. But I do want to bring this conversation back to the rest of the conference. The acceleration of information processing, and particularly quantum, what implications does that have for the safety of blockchain and the availability of digital currencies?
It has profound implications, because all the problems that blockchain have, and blockchain is just one means to provide security. It's a very clever one. Everybody earlier correctly identified it as really clever. Blockchain, not cryptocurrency per se, blockchain. All security has overhead, right? It's no different than if you put money in a safe, the safe weighs more than the money. And this is, in physics terms, it's exactly the same on networks. All forms of security create physical overhead in terms of hardware you need and energy consumed and latency. The more compute power you get, the more you can just make that stuff get light. That's the magic of code. So the trends would suggest that we could add profoundly better levels of security and confidence in networks of all kinds, not just blockchain, and make them useful at velocities that are impossible now. Because Bitcoin is terrible. I mean, seven transactions per second? I mean, for proof of stake and proof of work, great. But for transacting in commerce, it's worthless. That goes away within the decade, and other modalities like that. Quantum computing is a whole separate discussion. I'm just not buying the Kool-Aid. Quantum computers will happen. Nothing that's being produced today, in my opinion, is close to what a quantum computer is or will be. We're still in very, very early days of that. But quantum encryption is there, but that's just, again, I'll call it a mathematical trick. But encryption and security is the sine qua non of all transactions, especially financial. The real message of the acceleration of both the number of nodes on a network and moving compute power to the edges, which is smart chips in your phone, means that smartphone's level of encryption, sort of Apple-like on steroids, it will increase an order of magnitude. So the fact that I can commit transactions with fingerprints, iris scan, that's secure in my phone, not in the cloud, but the money's in the cloud, that level of transformation is already happening. It'll get cheaper and easier. So the dollar, a Zelle transaction becomes a penny. I mean, it will go away. And it will go away in, I'll pick a number, 5 years, maybe less. That velocity is really, really high. And that's both disruptive, based on everything we heard, right? Because the investors will watch this stuff and say, okay, when is it, when is it really a currency? I don't believe in any cryptocurrencies as a store of wealth. I don't think they will ever be a store of wealth. I think they'll be a great means of exchange, which is not nothing in a world where financial exchanges are more than 100 to 1,000-fold higher than the actual underlying value of an economy.
Okay, let me just bring, yeah, Steve?
So I have a question that goes back to Jim this morning, as well as the conversation on trust and record keeping. So Jim suggested the answer to Governor Waller's questions, what's the use of a central bank digital currency, would be that the sovereign would use it to control its population. So this is really a question for Leland. Do you think that's a risk given what we've seen in China? Or will these technologies, as Mark was saying, be able to bypass that kind of control from the sovereign down on their population?
A central bank digital currency scares the hell out of me for a lot of reasons. But the first is that for all the reasons that China likes it, it could be a potential disaster here. Not in the early going, but if it evolved. And the reason I say that is a digital yuan is not the typical currency. It's a surveillance tracking device. It is not decentralized. It is the government watching you and everything you do. So from that perspective, a digital yuan is not like something that the Fed could be asked to create, et cetera. But there are facets of the digital yuan that could be broadly applicable to other currencies, digital currencies, and that's why this gets a little bit scary. One of the most interesting things that they're experimenting with in China is exploding vouchers. So for instance, you have a digital wallet and you decide that tier 3, tier 4, tier 5 cities aren't doing that well, and you decide that you are going to, as the People's Bank of China, you are going to put 200 yuan in those digital wallets, and that electronically expires in 3 weeks. Automatic, immediate stimulus. Interesting. Beijing loves tinkering. The party loves tinkering their economy. This is this interesting, unwieldy but very interesting potential fiscal spending machine that allows you to do all kinds of interesting things you couldn't do before. Now, the reason this gets scary is imagine what that would do in the Fed's hands. You would have every politician knocking at the Fed's door saying, you know what? That population over there and that population over there, they need a little more support. I think that if you want us to keep our hands off the Fed and keep your independence, then you're going to have to help me out here. And so the potential for this to get extremely politicized, very, very high. And once you start creating these wallets and other things, you're going down a path that will be very difficult to reverse. So I don't doubt that we're headed there, and I don't doubt that there are reasons to go there, but we have not thought through some of the implications here. It's going to cause an enormous stress on people like Governor Waller and President Harker. It'll be tough to deal with.
Yeah. Although one feature, to your point, of the underlying transactional nature of what cryptocurrencies or digital currencies allow, the good part is it tokenizing things like, equity in a small business and profit sharing. So that when you create confidence in the blockchains, the counterparties, you have high confidence in the counterparties. And I want a small business to be able to directly raise capital from people who are interested in that kind of business. It creates some very interesting securities challenges, grant you that, but that's going to be a very interesting way to take out expensive intermediaries between fundraising. Small businesses have a hard time raising capital. There are people out there who would like to loan the small dry cleaner some money. This is done on a boutique basis sometimes, but you can imagine a trusted system that's really frictionless that could work. Same for giving money to charities in the DRC to help people get fresh water, where we mine our cobalt. It'd be nice to know I could give the money directly to the community where they need the water, it to be clean and not go through the kleptocrats, into the DRC's government and never gets to the... Those things, once they're tokenized and made secure and there's high transparency, really powerful. But, you know, how do you ring fence them so that's what they're doing as opposed to it's the DRC's digital yuan? I think we can do that. But boy, I think most of the dislocations that are coming are good for the world and for our economy, but not all dislocations cause all good things to happen. There's some very challenging problems coming in geopolitics and currency regulations and, you know, leakiness into bad actors.
Okay. I just feel like I've... I just want to bring Holly back in the conversation because I think we neglect small businesses. You know, if anybody goes to get their hair cut, or you know, they employ landscapers or repairing your roofs. I mean, these are small businesses, and you know, in economics, there's something called 𝗪𝗶𝗶𝗶𝗏 disease, which means that in a lot of services firms, wages just continue to rise, and they can't have any offsets to that. So we hear a lot about, you know, with labor shortages, our small businesses, I mean, I assume it depends on the industry, but their ability to substitute capital for labor is very limited in most instances and things like that.
They're certainly trying as much as possible. So our last COVID survey, when we asked about whether they are experiencing a labor shortage, 2/3 of them say that they're experiencing a labor shortage of some varying degree, and 1/3 of them say that they're trying to introduce technology to increase productivity.
Right.
So it just depends, obviously, on the industry, but also the availability of the technology that they can implement in their business. So some industries are more conducive to that, but you know, a lot of them are waiting for, you know, the technology that you're using when you say that you're using, you know, 2 big pieces of equipment and now you're using 10 little ones. Well, a small firm might want the 1 little one and introduce that into their business at a price point that they could afford. It just takes time for that to get to the point where a small business can implement those technologies into their firm. And, you know, it happens all the time. And those new firms are more likely to utilize those technologies when they first start out. But it does take a while to get to the point where a small firm can access that.
Okay. We had another question here.
Yeah, I got a question for Holly. When you survey those small firms, where is their attitudes and thoughts about financial services? Are they happy with what they're paying in payment systems and with the level of financial services that they're getting? What do they tell you in your surveys?
Sure. So for one of our questions, we asked, what is your biggest problem, your most severe problem in operating your business? And financing is really at the low end of the spectrum. So right now it's inflation, labor, and all of that, and then taxes and regulations. And then financing is, you know, pretty small number of folks saying that that's their single most important problem. For most of them, financing isn't generally an issue, although our members are more established, so they generally have a relationship with with their bank, and are able to either finance through their earnings, which is their primary source of financing, or if they're interested in a bank loan, are able to access it. Access is always more important than cost for financing. So if they have to pay a few more, points of higher interest, then that's fine as long as they can, as long as they can have that return available to them and what they're spending it on. But access is always the biggest issue for them. For the financing front. But right now, we've asked, one of our previous questions a couple months ago was, you know, the Fed increasing interest rates, you know, how is that impacting your business? And for many of them, it was, they are thinking that it's resulting in slower sales for them because those customers who have to finance the purchase of whatever they're selling are less likely to do so versus it impacting their ability or you know, their ability to pay for, you know, a higher bank loan.
Have you gotten granular enough to talk about payments or about the cost of collecting money with these small businesses? You know, we talked about a dollar per Zelle transaction. Do they have expressed any opinion about what they're getting in terms of payments and those types of fees that they have to pay?
It's a love-hate relationship. So, you know, with credit card fees, they're not happy. So it was interesting that somebody commented on, you know, some small business owners have, you know, kind of a transaction fee that's a line item on their bill. You know, for them, they wanted to show that this is an increased cost of them doing business instead of just incorporating it in a higher cost of their product or service, to, you know, kind of indirectly that a customer wouldn't be able to see. And they figure that if they can see it, then they'll understand why it's there, because obviously they're paying, you know, they're paying, or some of them are paying interest on their credit card bill. So, you know, there's some transparency that they think is beneficial for them to do that. But the kind of accounting side of things makes it far easier for them with their bookkeeping when it comes to using more digital payments and things like that versus cash. So it's definitely a love-hate relationship for small business owners and those type of transaction and those fees.
I seem to recall that there was a, back to the football analogy, Odell Beckham Jr., I seem to recall in his last contract he wanted to be paid in Bitcoin. So, Holly and Laura, is anybody, are you aware of, come to you and say, I want to pay for this bulldozer in Bitcoin or Ethereum?
Can I buy a D9 with Bitcoin?
If they are, we're saying no.
I've seen one small business in the storefront saying we accept Bitcoin, and I thought about going to ask, you know, how did you come up with that? And you know, the owner wasn't there, but I tried. But it was one.
It only starts with one. All right. Are there any other questions? All right. Well, let's give the panel a round of applause.
Okay, so I think we've completed, and now that Leland scared the living daylights out of us, we have a topic for the next meeting. I want to finish where we started, and to thank all of the speakers for coming and for participating. Without their participation and their expertise and knowledge, we wouldn't have the just fantastic day we had. So how about a round of applause one more time for... And with that, we're officially done.